likely to be the last hike, but clearly they've kept that optionality open where, there's so much additional data to come out until the September meeting that anything could influence their decision. But as of now, I would say for both central banks, it looks like this is the last one in their tightening cycle.
Well, Chairman Powell referenced the data points that he was looking forward to between now and the September meeting. There are many. We got some this morning, though, that were pretty darn impressive. GDP came out at 2.4% for the second quarter. We were looking for 1.8% in our survey of economists. Personal consumption, consumer spending, also higher than anticipated, 1.6%. And you got the core PCE, which is the Fed's preferred gauge of inflation, not nearly as bad as we expected at 3.8% rather than 4%. So this looks pretty darn Goldilocks to me. How do you think it looks to Chair Powell?
Well, you're absolutely right, Matt. I think we've even seen the IMF echo a similar viewpoint where the US has been and is proving to be a lot more resilient than investors expected at the start of the year. And I think, given the fact that the U.S. economy has been that resilient, it does open a Goldilocks environment because we have seen progress made on inflation. And given the fact that the growth has been quite resilient, it should put the Fed in a situation where they could hold rates at current levels. And then that expectation of them, beginning to cut just gets postponed further down the line.
So, Anika, you're based in London, I believe right around 1 King William Street, which is just right around the corner from Bloomberg's European headquarters at Queen Victoria Street. Talk to us about inflation. Inflation in the UK, inflation across Europe. Christine Lagarde called that out as still higher than she would like to see. Why is inflation in across Europe maybe a little bit stickier than maybe what we're seeing here in the US?
So I think what seems to be quite different in the UK is largely due to more structural factors. I think Brexit in a big way has contributed to inflation being a lot stickier. That being said, the most recent inflation report has shown a small sliver of cooling. But I think Brexit has a very important role to play as to why the UK seems to be the laggard in actually bringing down that inflation fight. But for the Eurozone, what seems to be holding inflation up quite strong has been the strength in the labor markets. Wages have been rising. And I think that has essentially, from an income standpoint, helped the Eurozone consumer actually have a better and a higher purchasing power. So you've got wages rising, you've got inflation beginning to come down, be it headline inflation feeding into lower core inflation. And that is just, from an income standpoint, making the Eurozone consumer putting them in a much better position. So I think those two factors really stand out. And that's one of the reasons why our fight on inflation has been a bit of a laggard compared to the US.
So you were talking about how rate hikes are going to get pushed back, but I noticed on the dot plot that we're expecting, at least the Fed itself is forecasting, a full percentage point of rate cuts over the next year. Why do you think that the Fed's forecast differs so much from what Jerome Powell, will say at any given press conference?
Well, I think it's purely based on the fact that the economy has been fairly resilient. There are also risks lurking around. We've seen commodity prices over the past few weeks actually rebound. We've seen, the escalation between Russia and Ukraine actually increase, with Russia pulling out of the Black Sea grain deal. And so as a consequence, we've seen agricultural prices within the commodity spectrum also rise. And I think central bankers have taken note of that these risks are there in the horizon. And for the US, it's quite important because, we're seeing growth quite resilient. For the Eurozone, we are seeing growth being quite tepid. Forward-looking indicators are saying there's weakness ahead. So I think the ECB is right to say that they've covered quite a bit of ground. There isn't all that more left to do so at this point in time. But for the US, as growth seems to be a lot stronger, and the consumer appears to be a lot more resilient. And you're also seeing a few inflationary concerns rising on the horizon. There's always the risk that the economy just does better than expected, and that gives less need for Powell to actually have to intervene with rate cuts.
What does that mean for the FX picture? I mean, we had seen the dollar hold strong for so long this year against all predictions, and then it came the Bloomberg Dollar Index came tumbling down a couple of weeks ago. Now it's on a steady climb higher. And the euro's trading at less than $1.10, right? The pound is trading at less than $1.30. What do you think the growth differential means for the currencies?
It has a very big impact. So what we've seen is the dollar responds to two important factors, one being the growth differential and the second being relative interest rates. Now, clearly, until now, the dollar was weakening because interest rates in the rest of the developed market world was actually rising, and interest rates expectations for the Fed were actually declining. So there were expectations for them to pause or cut. But the way things are evolving with the strength in the U.S. economy, we're now seeing relative interest rates move in favor of, continue to move in favor of developed market economies as opposed to the U.S. And at the same time, we're also seeing growth prospects in UK and Eurozone actually deteriorate compared to the U.S. And hence, that seems to be the dominant factor in play right now, which is why the dollar has been strengthening.
All right, Anika, thank you so much for joining us. Really appreciate getting your perspective. Anika Gupta, she is the Director of Macroeconomic Research for the Equities and Commodities business at WisdomTree. She is based in London. Again, we had the ECB this morning, the Fed yesterday. Rate increases, yes. The market's kind of reading into it that they may be perhaps the last of the rate increases, at least for now, when we're seeing some reaction in the markets. S&P 500 up 0.5%. Right now, let's head down to Washington, D.C. Nathan Hager's got world and national news for us.
That I do. Thank you, Paul. From New England to the Mid-Atlantic, from the Midwest to the Great Plains, about 170 million Americans are under heat alerts today. New York City is bracing for its hottest day of the year, and here in Washington, could hit 99 degrees before it hits 100 tomorrow. And it just so happens the White House is announcing steps today to help Americans deal with extreme heat. Bloomberg Government's Jack Fitzpatrick has more.
The Department of Labor issuing an alert that essentially are supposed to reaffirm that workers have heat-related protections under federal law.
Bloomberg Government's Jack Fitzpatrick reports President Biden will also announce new spending to improve weather forecasting and clean drinking water. The mayors of San Antonio and blistering Phoenix are going to be at the White House for that announcement. Hostilities have intensified significantly in southeastern Ukraine. That is what Russian President Vladimir Putin is saying, as Ukraine appears to be stepping up its counteroffensive. A U.S. official who asked not to be identified says Ukrainian troops are making a significant push in the Zaporizhia region in the south. Russian missile attacks continue on infrastructure in Odessa. At least one person was killed. A grain cargo was damaged today in the latest strikes. A coup attempt is underway in Niger. The foreign minister of the West African nation says the president, Mohamed Bazoum, is being detained by soldiers who claim they have seized control of the country. Secretary of State Antony Blinken is monitoring.
We are calling for the immediate release of President Bazoum. We're calling for the immediate respect for the rule of law and for public safety.
Secretary of State Blinken. And police are saying more now about the death of Sinead O'Connor. They say she was found unresponsive at a home in London yesterday. They are not treating her death as suspicious. They're not saying how she died, though. The London coroner says there will be an autopsy, but the results could take several weeks. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages are higher, but they are pairing some of the earlier gains. In the S&P 500, you had 7 of the 11 major industry groups in the index higher, being led by communication services. Yeah, that's where you find Meta Platforms. That stock alone good for just about 6 of the index points. Meantime, after today's better-than-expected economic data, James Anthony at Aberdeen Investments says the Fed's job has just gotten a little more difficult.
If the US consumer doesn't die down, if the US labor market doesn't soften, it's difficult to believe that they've found equilibrium, and it feels like they would have to come back to the tables.
The S&P 500 right now 28 points higher. That's up 0.6% at 45.95. Dow Jones Industrial Average, that continues its winning streak, 73 points higher right now, up 0.2%, 35,594 on the index. The Nasdaq 100 up 201 points, that's up 1.3%. NYMEX crude hovering around $80 a barrel. And then the largest U.S. electrical grid has issued a level 1 emergency alert. PJM interconnection concerned about being able to maintain adequate power reserves today. Somebody turns on the air conditioner. So
Don't plug in your car.
don't plug in your car. Also, there are businesses and consumers who are linked up in a program where they're notified and they agree to cut back their power usage.
Okay.
I think this building might be it, but
Well, we got everybody.
I do that too, actually.
all right, it's a
I
good
get a
idea.
discount for using, for example, charging my wife's car happens not during peak hours.
Oh, yeah.
You know.
Well, you do it overnight, right?
Yeah, well, whenever the grid allows us to do it, they turn it on and off.
Interesting.
Well, John's just going to go down to the beach today. That's how he
That's how
goes
I'm
down.
going to turn off the AC and just
Go down to the beach.
Well, if you get in the water, it's not going to be much cooler.
It's
you know,
nice. 72 today.
72,
72
yeah.
today. Perfect. It's dirty
surface
short.
ocean temps down in around Miami were over 90, and down.
No, it was hot
down in
tub
South
level.
America,
See, John and
100.
I, we
Yeah.
decided not to move down to Miami. We stayed in the Jersey Shore.
Good for you guys.
Anyway,
All right,
that's
John.
your Bloomberg
John
business.
Tucker, very good. All good stuff there. Gitu Sharma joins us. She's a founder and investment manager at Alpha's Future. And we'll talk to you about these markets. Gitu, I was just looking at the NASDAQ 100 index, as John Tucker was just reporting. It's up 43% year to date. It's just extraordinary. And we got another big move higher today. What do you make of these markets here? We're here at the end of July here. We've got central bankers seemingly at or near a plateau on rates. We've got earnings coming through pretty decently. What do you make of these markets right here?
Hi. Yeah, I think it's really impressive how well the markets have done year to date, especially after what we experienced in 2022. The markets, both the S&P and Nasdaq, have now erased most of the decline of last year, and a lot of it has really climbed a wall of worry. We don't see a recession coming, which was a big risk that everybody was forecasting last year. Even the Fed is very surprised on how strong the U.S. economy is doing. Today's GDP data shows that U.S. economy continues to move from strength to strength. The labor is really strong, and we don't see any of the economic downturn that was being anticipated. And tech, I think it's very impressive how the tech has rallied this year. Their earnings growth is really strong, and tech seems to be one sector that is doing well, irrespective of how, whether the economy is doing, strong or has concerns. Tech seems to have this mega trend around it. I think it has been a great rally so far, but it has also happened in the face of rising interest rates. We are now more than 500 bips higher in terms of cost of capital. So far, this has not impacted either companies or the consumer. And that has, of course, driven the rally, but we have to see how long this can continue.
So what do you think, Gitu, about the earnings picture so far? Tim Graff, with whom we talk a lot over at State Street, says it just hasn't been as gloomy as forecast. And I was looking in the S&P 500 where almost half of the companies have reported so far. Earnings growth there is up 3%. Sales growth is up 5%. And the surprises are widely to the upside as well. In tech, you're looking at surprises of 5.5% on earnings, so doing much better than had been expected. But you're seeing a little bit of earnings contraction for technology. What do you think about earnings season?
I think, yes, absolutely. But given how strong the U.S. consumer and the U.S. Economy is, it is passing through to the corporates, and they're able to achieve top line growth and bottom line expansion. They have been able to pass on the price increases, and the consumer just wants to, is happy to spend. And it seems like we are still coming out of the pandemic lockdown and still doing things for the first time in many years. So the recession calls have been pushed back. So clearly in such a strong economic environment, corporates are doing well, like we saw about the advertising growth that both Alphabet and Meta have reported. It looks like, businesses are continuing to spend. And I think the expectations for earnings were quite low coming into 23 because of this fear around recession and what the impact of high interest rates might be on corporate earnings and impact on profit margins. But we are not seeing that at all so far. And it looks like a really strong U.S. Both corporate and economic performance.
Gitu, is it maybe time to take some profits in technology? Had such a huge run-in?
I would think so. I think that just like we had at the time in October when it felt like the markets were just going to go down and we saw this reversal, which nobody was anticipating. You just don't know where the next leg of performance will come from. And it seems like market is pricing a lot of the good news in. There doesn't seem to be anything to worry about. And maybe you may think that that's the point of worry. So we are trying to stay nimble. We are trying to take profits wherever we can and investing in companies that might have, that still have positive momentum, but might have lagged year to date. We're very focused on quality and value to that extent. So we're looking to buy quality growth, but attractively priced, or quality and defensiveness that is cheap, because I think aggregate valuations look high. And I think the market is run up quite a bit, both on this soft landing narrative and a lower interest rate environment. But I don't know if the economy continues to stay strong. I just don't see why and how the Fed will actually come to cutting rates. So we might see a hold here for a long time, and somewhere down the line, it's possible that these high rates will start to bite companies.
Well, what do you think, by the way, about private credit? Maybe it sounds like a weird question, but we've been hearing so much about it lately. I mean, it just seems so juicy, too juicy to ignore.
Well, so I only work in the equity market, so I won't be able to comment much about how the private credit market is working right now. But clearly, it looks like it's a segment of the market that is doing well right now, as your risk-free rate is so high, and companies that are not able to access capital through the banking system are reaching out to the private markets to get access to capital, and therefore they're able to earn, or at least target a higher rate of return.
Yep.
And but it's a new emerging market largely, and we really have to see how long, what are the economics of it and what kind of default rates they might have to see over time. It's too early to say that.
All right, Gitu, thank you so much for joining us. Really appreciate getting your perspective. Gitu Sharma, founder and investment manager at Alpha's Future LLC. Kind of getting a view there, kind of taking some profits there in technology, and why not? The S&P or the NASDAQ 100 is up over 40% just so far year to date. Just an extraordinary beginning first half of the year. For
Best first half ever.
Best first half ever. There you go. Maybe take a little bit of profits, as Gitu is suggesting. S&P 500 up 0.6%. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. 3M's agreement to pay as much as $12.5 billion to settle lawsuits over so-called forever chemicals, well, that's facing opposition from more than a dozen states. Bloomberg's Gina Cervetti reports.
That say the deal is worth far less than it appears. The states, District of Columbia, and 2 U.S. territories argued the proposed accord contains provisions that could force local water providers affected by chemical contamination to reimburse 3M for many costs.
Now, shares of 3M right now, they're down about 1%. And Renault's first half results, they exceeded expectations, with operating margin rising to a record. CEO Luca De Maio spoke with Bloomberg TV about the biggest contributor to its future success.
We would be launching, 12 new models next year. So normally in the automotive business, when you have a fresh product, everything works. So we are pretty optimistic about the future, although we understand that, environment is very challenging for a number of reasons.
De Maio also said the company can hold solidly in the mid-sevens on margins. Shares of Renault right now, well, they're up about 2%. And it's a blast from the past for Toyota. The company is bringing back the Land Cruiser to the U.S. Now, Instagram post from Matt likes that. Instagram post from the Japanese car maker. They've showed the side of a mud-splattered, unidentified vehicle and a vague caption about a new adventure beginning. Well, the company would not say if that picture was a Land Cruiser, but it did say that it would confirm it during a news event that happens August 1st. Now, shares of Toyota, check in with those. They are down, up just a fraction right now. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
We have to redo that rejoin because it's now Paul Sweeney and Matt Miller back in the game here. So
I'm back.
You're back. Markets, how about that? The markets are back as well. A strong day in the markets. We had the ECB raising rates, but hinting that it might also be at or near the peak. We've had some strong earnings coming out, particularly out of the tech world, and that all leads to a strong market. S&P up 0.5%, NASDAQ up 1%. The NASDAQ 100 really giving you the juice there, up 1.3%. But the Russell, not feeling the love here, still kind of just flat, slightly up today. So we're not seeing that broadening out to the smaller caps. But we will call out WTI crude oil. We did touch 80 today. It's up 1.2% right now. It's $79.73. So a little bit of inflationary move there. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Where we have some breaking news. Paul, lawyers for former President Donald Trump are apparently back at Special Counsel Jack Smith's office in Washington. This is according to a report from the Washington Post citing a person familiar with the matter. This comes more than a week after Trump said he had been told he is a target of the Justice Department's investigation into efforts to overturn the 2020 election. This meeting could be another sign that Smith is close to seeking charges against the former president. If it happens, it would be the third indictment for Trump in the middle of his campaign to return to the White House. The Supreme Court is giving the green light to the Mountain Valley Gas Pipeline. This is the 300-mile project backed by West Virginia Senator Joe Manchin that would deliver natural gas through the Appalachian Mountains in his home state and in Southern Virginia. A federal appeals court had blocked construction earlier this month despite language in the debt ceiling bill that would have let it move forward. The High Court's decision lets work resume while allowing environmental opponents to press ahead with their case against the pipeline. Senate Minority Leader Mitch McConnell's freeze-up on Capitol Hill is raising new questions about the health and age of people in positions of power. Bloomberg's Anne-Marie Hordern has more.
You look at some of the data, and a lot of Americans actually want to see upper-level age limits on elected officials, but at the same time, a lot of Americans say older individuals are very wise and they should be able to serve if they are healthy, and they should be able to do that if they have the cognitive mentality to do so.
Bloomberg's Anne-Marie Hordern in Washington. Senator McConnell is 81 years old. If you happen to be listening to this broadcast in your car, this may be of interest. A Senate committee has approved legislation that would force automakers to keep AM broadcast radio in new cars. This follows moves from automakers like Tesla and BMW, which had removed the frequency from their vehicles because electric vehicles have electromagnetic waves that can interfere with the transmission. At the markup, Republican Senator Ted Cruz said Americans rely on AM radio to provide them with safety alerts, news, talk radio, and music. And Bloomberg radio.
Exactly.
Yeah, global news, 24 hours a day. Powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg. Paul and Matt.
All right, Nathan Hager.
Yeah, thanks, dude.
I haven't had to say that in a while.
I know.
I like the sound of it.
Yeah, same.
It means a gift from God.
Oh,
that's true.
Is that what they told
in
you?
the original Hebrew.
My mom and dad told me.
That's what, yeah, your little gift from God. All right, Nathan, thank you so much. We appreciate it. All right, 2 years ago, Toyota said goodbye to the Land Cruiser in America, but now, during a July 26 phone call, Toyota spokesman said the Japanese car manufacturer will announce details of a U.S.-bound Land Cruiser on August 1st. And I know I like the old vintage Land Cruisers.
Love the old Land Cruiser. Actually, you know who has one?
Who?
Barry Ritholtz.
I was going to say, and guess what? He's going to co-host us in the 12 o'clock
That's
hour.
excellent. So Ritholtz has an old Land Cruiser that he had like rotisserie restored.
Really?
So completely stripped down, taken apart. They call it frame off restoration. But I like the new ones too. The problem for me was that until they discontinued them, they were so expensive. They priced them so much higher than, for example, the Sequoia, which is the biggest, Toyota SUV. And I think that effectively took it out of the market for anybody who wasn't, willing to shell out basically $100,000 for a Land Cruiser.
Well, again, but the Ford F-150 Lightning that you got for me.
Well, now all cars cost $100,000. So, I'm saying back in the day, it was very expensive.
All right, we'll take a look. We'll stay on top of that story. You know we will. We're gonna have more coming up. This is Bloomberg.
This is Bloomberg Markets
with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets
with Paul Sweeney
on Bloomberg Radio.
All right, coming up on this hour, we're going to get the latest on these markets. Jess Metton just entered the studio. She covers all the markets for us, so we'll get the latest. She is not wearing green, I'll tell you that, folks. Also, this hour, we're going to check in with SEC Chair Gary Gensler. He's going to sit down with Kaylee Lyons and I believe Danny Berger from Bloomberg News. Talk to him about the regulatory outlook for the SEC and maybe touch on crypto.
Yeah, that's going to be a huge interview, especially considering the fact that Kaylee Lyons is the co-host of Bloomberg Crypto.
Right, and she is in, I believe, D.C.
Yeah, that's our weekly program focused on the crypto industry, Tuesdays at 1 p.m.
Nice. I saw what you did there. That's good stuff. So we'll have Mr. Gensler on, so we'll figure out what's going on with our good friends at the SEC. But let's kick this hour off with John Tucker and get a Bloomberg Business Flash.
All right, no signs of a recession here. Economic growth had accelerated in the second quarter. Consumer spending led the surprise gain there in GDP. Also, jobless claims falling for a third week. Rally in the NASDAQ 100. That's being led by Meta Platforms. The Dow on track for a 14th straight winning session. S&P 500, that remains just about 4% away from its all-time high. So can you put more money into stocks? We put that question to Marvin Lowe at State Street Corporation.
So you can, and there is liquidity support in a market where if kind of those recession concerns get pushed out a little further, you can continue to see that money gravitating towards risk.
And the financials, one of the drags on the S&P 500. Regulators want lenders to boost their financial conditions. S&P 500, 23 points higher. That's up 0.5%. The Dow, 37 points higher. The NASDAQ 100, 190 points higher, a rise of 1.2%. A shortage of penicillin to treat a skyrocketing number of syphilis cases so dire. U.S. health officials are debating the need to declare a public health emergency. So the situation partly a result of underinvestment in drug manufacturing. This comes after years of falling generic drug prices. So that's part of the economics of this whole thing.
Makes me so glad I'm not single anymore. You know?
I just knew Matt had to comment on that story.
How's that Bumble profile going, JT?
You're just not going to let that down.
I've got that video cut ready for you to add to your profile.
I'm okay. I'm set. Maybe a new dog at some point.
Yes.
Yeah, we need to do that.
In that case, you're probably safe from syphilis.
Yeah. Anyway, that is your Bloomberg Business Flash. I'm John Tucker.
Matt is back, isn't he?
Matt is back, Paul.
Yes, he is. All right. John Tucker, thanks so much. We appreciate that. Matt Miller, Paul Sweeney here in our Bloomberg Interactive Broker studio, streaming live on that YouTube thing. Just head over there and search Bloomberg Global News, and you'll get it. Jess Metton darkens the door here. She comes in. She covers all the markets for us. Jess, what do you got for us in a nice green tape out there today?
So I was actually, at first, I saw this story on the terminal about the BMWs and Mercedes cars that are aboard a ship that are likely to burn for days. Yes. And I thought of you, Paul.
I know.
I got worried. I was like, you're all about the BMWs, not the F-150s that was apparently in your driveway that you said you were uncomfortable with.
Yeah, that was an uncomfortable moment.
You didn't like the image that portrayed?
Truck
he couldn't deal with it.
Was not good.
No.
I had people, neighbors driving, would call me and text me and said, "Oh my God, you got a pickup truck?" I said, "No, it's for my son. It's not mine."
Tried to
and he'll be leaving
distinguish it
very shortly with it.
So I'm taking a look at, for individual stocks, some of the restaurant names this morning. So I'm looking beyond just what was going on in the tech and growth space, looking at Chipotle. So that stock down close to 9%. So on pace for its worst day since March of 2020. Did come after the company did miss Wall Street's expectations for the second quarter. So those sales did fall short of those estimates. And then as well as the current quarter, for the third quarter, also disappointed. And so seeing that steepest drop there, but then also on the other side of things, if you look at McDonald's, top line growth did moderate. So you did see some of its estimates did come in better than expected, but the problem was it did warn of this slower growth ahead. So when you are looking more at the restaurant space, that down. But in general, if you're looking more broadly in the S&P 500's restaurant subgroup sector, it's actually just flat because you have other names in there like Starbucks and Darden, Yum Brands, and those are holding up well. So it's really just those two particular names that are dragging those two stocks lower, but in general, that sector is still flat.
Is that consumer discretion?
Yes.
The restaurants, because
Right.
the bigger eco group, their earnings are up 27%,
Right.
which is just unreal. I noticed that tech earnings are actually down. If you use the EA function in the S&P, tech earnings are actually down 1.25%.
So the top 5 stocks in the S&P 500 were expected to have a 16% year-over-year earnings growth compared to the broader index's negative 9 contraction for the S&P 500. So when you're looking at some of these bigger names in general, they have been expecting brighter times ahead, and some of them have actually been delivering on those earnings projections, and that's some things that Gina Martin-Adams over at Bloomberg Intelligence have been watching pretty closely. Something in particular, though, if you look at the communication services sector, which obviously you think of names like Alphabet, Google, also Netflix, as well as Meta, that when you're looking at the valuations for that particular group, they're not as lofty as some of its other sort of growth-like counterparts in the S&P 500, if you're thinking about discretionary or obviously technology. So Gina and her team at BI were thinking there actually could be some more room there to run for some of these stocks that are actually housed in the communication services sector, because I think we talk so much about tech, but a lot of these sort of tech-like names are also housed in some of these other sectors, or when you think of like Tesla and Amazon and discretionary too.
Well, speaking of Meta, Bloomberg's got a story out talking about Mark Zuckerberg adds $8.5 billion in wealth as Meta shares surge, and he's number 10 on our
Rich Go,
top richest folks out there, and he's certainly to jump up a few spots after today's move. So feeling good for Mark Zuckerberg.
Yeah.
Good day for him.
Well, something else I've been taking a close look at is because everyone has been talking about, especially in recent months, wanting to see this broadening out in the stock market. So if you're looking at the Russell 2000 and its comparison compared to actually the RSP, I'll bring up some ETFs because I know that's something that Matt obviously follows really closely. So record amount of money went into that ETF in June of around $5 billion, but then since then more than $6 billion. So that was its best month on record if you go back the past 20 years for that ETF. So that's more of like obviously measuring the equal weight for the S&P 500. But then if you're also looking at what's happening with small caps, in particular the industry groups within small caps this quarter, really on fire if you're looking at industrials as well as materials. So clearly those groups that are very tied to the health of the economy, and those really holding up well. And then just more broadly in the S&P 500, if you're thinking, I mean, also obviously the Dow with this long winning streak that John Tucker was talking about, which would, if it can be 14 straight days today, it would be its longest winning streak on record and beating that record that we did see in 1987. But a lot of these more kind of cyclically tied quarters of the market.
That was Paul's first year on the street.
It was. I've heard these stories.
Yep. By the way, just looking at the Russell 2000 in terms of earnings, and to be fair, only 390 companies have reported so far.
So the bulk of it is actually next week, more than around 40% of the small caps.
But of those that have reported so far, you see an earnings contraction of 10%. So this quarter, Russell 2000 earnings, at least so far, have been decimated.
Well, the thing is also what Gina likes to talk a lot about is the revenue recession for small caps. So you have obviously the bulk of them reporting next week with 40% of the market cap for that. But she feels like the pain point in the margin pain for that particular group, when we're talking about these smaller companies, were actually in the second quarter. So she's thinking that brighter times are still ahead when you're looking more 6 months to a year out for some of these small caps. And a lot of it is really been improved more so in the industrial sector within the small cap space. And so that's clearly tied to the economy. So even though there are some issues still there when you're looking kind of on the surface for earnings, there are some things underneath the hood there that looking out 6 months to a year from now actually look pretty good for small caps.
Had some good news in the cruise business. People are going nuts there, which I thought,
it was
now
all good until the syphilis explosion,
Yes, let's tie those stories in.
Right. Yeah. So if you're looking at some of these cruise names, especially just like Royal Caribbean, obviously seeing some improvement there. But I feel like we always end up talking about the cruise liners and whether or not we're going on them. And then we always end up talking about how you haven't gone, right?
No.
I haven't gone. John?
No.
No.
But I see.
We should. Have you gone?
I went on a Lindblad cruise up the Nile.
Oh, those river cruises. I heard
Yeah.
those are pretty cool.
That was, well, Lindblad. I can't say enough good things about that company.
Well, maybe we should. Maybe we should all do this.
Didn't they make a movie about that?
But I was 12.
You were
So,
12,
and, you know, I'm turning 50 this year. I guess I need to do it again.
All right. Let us know how that goes. But no, it's
Not going to Alaska, that's for sure. I know that Abramowitz was there, and you want to go to a cruise in Alaska?
Yeah,
I don't get that. I want to go to a cruise somewhere where it's warm.
Yeah.
Come to the Jersey Shore.
Wait a few weeks; it'll be warm in Alaska.
That's a good
Yes,
point.
that's a good point.
Yeah.
All right, Jess Menton, thank you so much. We appreciate it. Jess Menton covers all of the markets for us. We're waiting on Mr. Gary Gensler. He is the chairman of the Securities and Exchange Commission. He'll be sitting down with Kaylee Lines and Danny Berger of Bloomberg Television in just moments. So we'll bring that to you because we need to talk about crypto. And we need to get some, I think the crypto space would love to get just some more guidance on kind of where the regulatory framework is.
Yeah, you know, the interesting thing is, of course, crypto front and center when talking to Gary Gensler, especially after the House Financial Services Committee, I believe yesterday, passed a bill that will give some real regulation to the industry. Now, it still has to get past a number of hurdles, and it's not likely to see the light of day anytime soon, but outside of the House. But that's interesting. The other thing that the SEC is really trying to crack down on is use of artificial intelligence on Wall Street. And that, you know, that's... Yeah, I was going to say bigger than syphilis, but it doesn't seem like I should carry on.
I think
that
we can
joke.
let that one go at the moment.
That's a rough story that John Tucker brought us.
It is. All right. All right, let's go bring you a live exclusive conversation with SEC Chair Gary Gensler. He joins Bloomberg's Kaylee Lines and Danny Berger on Bloomberg Television. This is an exclusive discussion, and we're going to go there right now.
We welcome now our Bloomberg television audience and radio listeners. We're joined for an exclusive interview with the chair of the SEC, Gary Gensler. He is here in our Washington studios. Mr. Chair, thank you so much for being here. I'd like to begin with your newest rules that you just unveiled yesterday, putting restrictions on brokerages and money managers and their use of AI to interact with clients. What is your primary concern with the adoption of this technology that you're trying to address?
First, Kaylee, it's good to be with you, but talking about this, I think that predictive data analytics, including artificial intelligence, is the transformative technology of our times, and every bit as transformative as the internet or mass production of the automobile 100 years ago. Now, what are we trying to address? When an investment advisor or a broker works with you as an investor, they're not supposed to put their interest, the advisor's interest, ahead of yours, Kaylee, as an investor. And so what we're trying to do is make sure that the technology aligns with that standard, that the technology that can predict about each and every one of us so much about how we might react to a little behavioral prompt or a little nudge, how we might react, that they're putting our interest as an investor in the right place and not putting themselves ahead of it.
And of course, the AI move wasn't the only one you made yesterday. You also just approved a plan to require companies to disclose cyber breaches within a 4-business-day timeline. Why is that the appropriate time frame?
Well, if I could just give a little bit more, it's about material incidents. So if a company lost a factory and that factory is wiped out and that factory is material to its operations, let's say because it's lost to a hurricane, investors need to know when they're buying and selling the stock. In a similar way, if you had a cyber incident that management determines is material, you know, hundreds of millions of files lost or something, or compromised, investors benefit from that disclosure.
But giving businesses just 4 days to disclose that.
That's what we have in our rules today. Currently, 4 business days, if you have, like if that factory, you know, was wiped out by a hurricane, to put out the material information. And so that's consistent with rules on the books. And by the way, many companies have been making such disclosures. Some haven't. It's been fragmented. And we thought it was important to bring some consistency to it around these material events.
Mr. Chair, Danny Berger here in London. Really wonderful to speak with you today. Now on some of your proposals when it comes to equity market structural reforms. You joined Bloomberg TV back in March. You said of market participants, give us your best advice. Tell us what you think. What did you get? What was the best advice you got?
Well, we got, in terms of equity market structure, thousands of comments. So I would say that what we're about at the SEC is trying to drive greater efficiency and competition in those markets. So when you send an order into a broker, that you feel that you're getting best execution on that order, and also that the markets themselves are competitive. So one of our rules was about sort of leveling the playing field between the lit markets, the so-called New York Stock Exchange and NASDAQ and so forth, and the wholesalers or dark market, which at times the dark part of the markets are between a third and a half of the market. So it's trying to bring some, level the playing field and ensure that investors are getting best execution in these markets.
What about in terms of the feedback you got? Are you taking any of that on board? Would you change anything considering what you've heard so far?
Well, we do that as a regular basis. When we make a proposal, we put it out to public comment and get feedback. And we put out 4 separate proposals for different aspects in the markets. And I think we've gotten 4,000 to 6,000 comments on each of them. So, and we naturally consider it, and the staff makes recommendations about adjustments.
Okay, I'd like to discuss another proposed rulemaking that has received a certain degree of feedback, your climate risk disclosures, specifically as it relates to Scope 3 emissions. What conversations are you having around Scope 3 in particular?
Well, we've heard a lot from the public on this, but to set the stage, companies today are making disclosures around climate risk. In fact, well over half of the top 1,000 or so companies currently make climate risk disclosures, including greenhouse gas emission disclosure. So we're trying to bring consistency to that. And yes, for investors, that they can compare comparability for that. You asked about one part of greenhouse gas emissions, so-called Scope 3, which is about the supply chain.
Right, where a lot of the concern lies.
And so we've heard from a lot of commenters about that, both from issuers and investors. We understood when we made a proposal that this was not as well developed, so-called disclosures around supply chain emissions. And so we're taking that into consideration. And as I just chatted with your colleague, the staff considers what to recommend upon adoption and whether to make adjustments.
So we could see a change there, potentially.
Well, just as in the equity markets that I talked about, we do take these comments seriously, Kaylee. It's a really rigorous exercise. In climate, we got 16,000 comments.
Wow.
So it's a lot to sort of sort through, but the Scope 3 issue is one that we've heard significant comments. Interestingly, we've heard from, I think, 48 or 49 of the state farm bureaus, literally about, well, what does this affect? And we only oversee the public companies, these 6,000 or 7,000 public companies. That's it. We are a disclosure-based agency. I often say we're merit neutral. We're not this disclosure is about something already happening between investors and issuers. And it's an important thing to bring consistency. It's not about those, those farmers and ranchers who thoughtfully wrote us. So we've heard.
Okay, I'd like to move to a different topic, which has gotten a lot of attention lately, crypto. Specifically, a ruling that was made in the Ripple case that XRP is only a security when sold to institutional investors, not so with retail investors? I know you've previously said you were disappointed by that ruling. The SEC has also said that it intends to seek further review. So does that mean you are going to appeal it? Can you elaborate on your thoughts around that ruling?
Kaylee, great question, but the commission, I'm one of 5 commissioners.
Mm-hmm.
The commission has not acted on that, and if the staff makes a recommendation, we'll have a discussion of it, and we'll take it up then, but I don't really have anything more for you for that.
In the meantime, as we wait for this, what does it mean for your efforts around crypto, for your efforts to try to protect the consumer in these areas? Does it complicate it?
Look, this field of crypto investing, a lot of investors should be aware it's not only a highly speculative asset class, it's also one that they currently should not assume that they're getting the protections of the securities laws, even though the securities laws apply to many of those tokens, without prejudging any one. But you as investors are not getting the full, fair, and truthful disclosure. And the platforms, the intermediaries, are doing things that we would never in a day allow or think the New York Stock Exchange or NASDAQ would do. The platforms often are commingling and trading against you and have market makers that are on the other side of your trades. And we don't allow that in the rest of our securities markets. And the securities laws are there to protect you. And that's right now, this is a field rife with fraud, rife with hucksters. And there are good faith actors as well, but there are far too many that aren't.
And of course, you've brought cases against crypto exchanges on this point. But do you need to change tactic? Does it change anything for those cases? Again, this XRP ruling.
Again, I'm not going to go into any one ruling, but I think that the securities laws are clear. And if the public is investing in your project because they're anticipating profits based upon the efforts of that project or those entrepreneurs, Congress painted with a broad brush. And I would ask you this, it's like when you look at a token, you can find a website, you can find a CEO, you can find a Twitter or X feed, whatever it's called these days. And there are entrepreneurs behind many of these projects without, again, prejudging any one of them.
Elsewhere in the crypto space, I'd like to discuss the spot ETF, because we have seen a wave of filings recently from BlackRock and others trying to finally achieve this. One has never been approved in the US, just a futures ETF. It seems like everyone thinks there has been a tone shift, that something is different this time around. What do you make of that wave of recent filings? Has anything actually changed for the SEC?
Well, Kaylee, it probably won't surprise you. Those filings do ultimately come up to a 5-member commission, so I can't prejudge any filing. But back to your colleague, as I said, this is a field that there's a lot of non-compliance in this field, and that the platforms themselves, where trading is occurring of various crypto tokens, though some of it comes under the securities laws, currently they're not necessarily compliant with those time-tested protections against fraud and manipulation.
Okay, on the subject of securities laws, which obviously is your purview at the SEC, just yesterday, House Financial Services Committee passed through committee legislation on crypto market structure that would actually give more authority in regulating this space to the CFTC. Still has a long way to go if it were to become law, but what is your thought on that legislation?
I sort of share my thoughts directly with members on the Hill.
And what have you told them?
I understand your question, Kaylee, but I think that those members on the Hill would appreciate if I continue to share my thoughts directly with them.
Not too dissimilar, Mr. Chair. I wonder if there's some degree that you would want a wider scope when it comes handing down fines to bad actors. Do you think it would be helpful to have higher fines, again, in order to discourage certain behaviors?
I would say this. We have good tools at the SEC around not just penalties, but also what's called disgorgement to give back ill-gotten gains and so forth. But if you're asking whether we could use more authorities, I would say we need more cops on the beat. We need more resources. Our agency is just the size we were in 2016. We actually shrank. We've kind of come back, and yet the markets have grown so significantly in those 7 years.
And finally, as you say, you need more resources. I wonder how you feel about the ability of you to get those things from this Congress in particular, when you have certain members of Congress who have said things like introducing legislation to remove you as chair, referring to tyrannical chairmen, including the current one. Does it make it more difficult to do your job when there is that kind of political rhetoric out there in your efforts to protect investors?
We work closely with Congress and individual members, and I look forward to those public debates. I think that we're really an important agency. The capital markets really wouldn't work without cops on the beat and rules of the road. Just, think if you're watching soccer matches. If there were no refs on the field, what would that soccer match look like? It would look first more like rugby, and then after a while it would really look worse, and fans wouldn't come to the field anymore. Or, well,
I can
most
see that
wouldn't.
vision.
So I really do think that it's important to have this agency, and we're part of these well-regulated markets.
All right, we have to leave it there. Thank you so much for your time today. SEC Chair Gary Gensler joining us on both Bloomberg Television and radio.
All right, that was SEC Chairman Gary Gensler with Bloomberg's Kaylee Lines and Danny Berger. We're going to have a little analysis of that discussion coming up. But right now, let's kind of get a reset out there with these markets. We'll go to John Tucker for Bloomberg Business Flash.
All right, look at this. The Dow Jones Industrial Average now lower, down 7 points, and you kind of blame Honeywell for that. The company's third quarter profit outlook missing expectations. So that's the biggest decliner right now in that index. S&P 500. That remains higher, up 21 points. That's up 0.5%, 45.88 on the index. And the NASDAQ 100, that's higher, still pairing some of the earlier gains, up 209 points. That's a rise of 1.4%, 15,707. And Meta Platform results helping there. Right now, the two-year yield, 7 basis points higher after the better-than-expected economic numbers today. 10-year yield, that's also 7 basis points higher. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. We appreciate it. Matt Miller and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We just heard from SEC Chair Gary Gensler talking about a wide range of issues here, an exclusive Bloomberg television and radio interview. I want to bring in Nathan Dean and get a little post-mortem here. He's a senior policy analyst for the U.S. and Latin America for Bloomberg Intelligence. So, Nathan, Gary Gensler was asked about AI right off the bat. I mean, this is going to be an issue for so many industries, not the least of which is the financial services industry. Is the SEC up to the task of kind of trying to get ahead of this thing?
So, it's funny. They just put out a proposal yesterday talking about predictive analytics and AI usage among brokers. And I read all of the 283 pages. And it really comes down to this is just the first of many things the regulator is going to do. What this proposal essentially said is, look, we know you're going to use AI, but we just need to make sure that you actually understand this. But they didn't really put any requirements of like, okay, well, it's just make sure that there's no conflicts of interest. So I think it was just like the SEC's first stab at this, but this is Washington. There's not a ton of folks down here that are artificial intelligence experts. So it's going to be a growing concern, and I think you're going to see more coming from both the regulators and Congress over the next few years.
So 283 pages long and no concrete proposals.
Yeah, it was.
What is in it, Nathan?
There's a lot of economic. To be fair, a lot of these proposals are actually on the lengthy side because if you don't put in standard disclosures or standard language and so forth, you run afoul of potentially what is known as the Administrative Procedures Act, and that's how they can come back at you in terms of courts. And that's actually one of the things that if you notice Chairman Gensler, he didn't really say a lot in terms of like giving specifics on what you're going to do with Scope 3 or the Bitcoin ETF, because the SEC is actually in several court cases cases at the moment. And, that's the question everybody wants to know is, Chairman Gensler, are you going to proceed with this, all these plans that you have, and then fight it out in court and potentially lose? Or are you going to try and dial down the controversy, if you will, and try and get it passed? So, I don't think he was, he's really good at keeping things close to his chest, but I think what I can say is that the SEC is going to be in a lot of court cases on a variety of rulemakings for many, many years to come.
All right, how about crypto? He was asked about crypto, and I guess one of the questions is it a security? Is this in the realm of the SEC? What's the latest thinking?
So there's actually two outside interests that are impacting the crypto debate. The first are the courts. So, Kayleigh referenced the SEC versus Ripple ruling. That ruling said that crypto is sometimes a security, sometimes not. It depends on the usage. That's not really good for clarity. So, then people have been asking Congress to come in and try and pass their own bill. The House Financial Services Committee is having a markup as we speak. There was some drama this morning. Some of the Democrats picked up, took their toys, and walked out for a little bit. So I don't think Congress is going to do anything. So the issue here is, how does the SEC police crypto in the interim? And they're going to continue with this idea that 98% of the crypto tokens out there are securities, and then the courts are going to have to intervene or, change or give the SEC approval to do that. We think the courts are actually going to take more of a crypto, or we'll say an SEC skeptic view, if you will. So you potentially could see more rulings. If you're following the Grayscale case, this is Grayscale's attempt to create a Bitcoin ETF. That could be out any day now. We anticipate that's going to be in favor of Grayscale. So it would be another loss for the SEC.
What did we get yesterday? The House Financial Services Committee, passed a bill. You can't say passed a bill, right? What they agreed on some legislation that will put clearer rules around crypto.
Yeah, so yesterday the House Financial Services Committee had a markup for what's called the Financial Innovation of Technology for the 21st Century Act, or the FIT Act. And that markup is, there's a second markup happening in the House Ag Committee for the same bill. What the House
in the Agriculture Committee for a piece of crypto legislation.
Exactly. Derivative traders laugh all the time when they wonder why CME and ICE are actually overseen by the Ag Committee, but it's because of those future contracts. And so both of these committees are going to advance this legislation without Democratic support. Or actually, I should say minimal Democratic support. We saw 6 Democrats go along with this. The problem for these crypto bills is that they're very broad, and then you're going to run into the risk of the Senate, which is Sherrod Brown over the Senate Banking Committee. His view is that there needs to be customer protections in place to avoid like the FTX scandals of the world. And, it's not something that Congress is going to be moving on anytime soon. Congress is like a submarine. They can't stop and pivot almost, instantly. So, this bill potentially could pass the House later this year or next year. I will say you're going to lose some momentum because this is right before the August recess. All the policymakers are heading out to the airports on Thursday night. So, I think this bill eventually could see more debate, but I do have more confidence that a stablecoin bill could pass in the next 6 months.
I'm going to pivot to weed for a second because Nathan, MasterCard yesterday told payment processors and banks to stop allowing marijuana transactions with debit cards. And that's the way I think a lot of unlicensed vendors do sell weed to people with plastic, as they make it a cash withdrawal transaction with a debit card and a PIN. Is this the kind of thing that safe banking needs to address? I mean, surely MasterCard would like to make money no matter what's getting sold. So how close are we to passing some kind of legislation on that?
So to answer your question, absolutely. I mean, there's been many, many instances of people saying, look, if I own a marijuana dispensary, I'm walking out of there that evening with $50,000 in cash in my backpack. That's not safe. Hence the name Safe Banking Act. The problem is that, marijuana is still federally illegal. I mean, you have all these states going forward with their own decriminalization procedures, but still there are just enough folks in the Senate, and I don't really call it a partisan issue, I call it more of a generational issue. There's enough folks in the Senate that just aren't on board with this. And, the question then is, okay, when are we going to get it? And we've started to see statements from, GOP presidential candidates. Some of them are on board, some of them not, but are they willing to put the political capital out there? So I still think we're a few years away until we actually get some clarification on this.
All right, Nathan, great stuff. We can ask you anything DC related, and you are there. Nathan Dean, Senior U.S. Policy Analyst with Bloomberg Intelligence, based down there in DC. That's the only downside. All right, let's switch gears a little bit. We were talking about AI in the context of financial services, businesses, and markets. It's also a big deal basically for every other industry out there. And what does it mean for a lot of these industries and people that work in the industries? Think Hollywood, writers, that's come up in their discussion. Rania Sedholm joins us. She is a managing partner of Sedholm Law Group. She joins us live here in our Bloomberg Interactive Broker Studio. Thank you so much for joining us. So what are some of the early thoughts within the legal community about AI? 'Cause I don't know where this thing goes.
Thank you for having me. Well, AI is definitely a hotbed topic, and there are so many issues to discuss. We don't have time. We can speak for days. But, you know, one thing that I'm concerned about as an attorney is the use of AI. While I don't think there's going to be a nefarious use in the labor dispute, as the technology becomes more prevalent and accessible, who knows what anyone will actually be saying? Because once I've captured, you know, your image and your tone using AI, I can manipulate it to say anything. And so this is going to raise a lot of eyebrows.
And is going to raise, I guess, a lot of lawsuits, right? I mean,
yes.
For the legal industry, this is going to be a big moneymaker.
It very well can be. You know, another legal issue that we're talking about is what kind of intellectual property rights exist when you use AI. Right now, the answer is none, because it only protects original works created by a human being. And so there's a huge discussion now as to what is the purpose, beyond making money, of course, right? You create a television show or something else using AI quickly, and you make money when people watch it. Okay, fine. But do you actually own it?
Yep.
Likely not.
So what are the, like, for example, just in this writer's strike, forget the actors for the moment, but just the writer's strike, I mean, that's intellectual property that they have created. And I guess the question is...
There are two issues there, right? On the one hand, they don't want anyone using the IP that they've created.
Right.
On the other hand, they're worried that AI is going to come in and write new material instead of them doing it.
Yes, exactly. And depending on what their current CBA, collective bargaining agreement, says, they may have already relinquished all rights to use of those materials. I don't know.
They've already written. I mean, for example, Sarah Silverman wrote a book, and it's been, I guess, accessed by OpenAI in training, I would guess.
Yes, that's exactly right.
And so, and now she's suing what, OpenAI?
She's suing OpenAI and Meta. And it's for copyright infringement, because one of the ways you can infringe upon copyright is to utilize someone else's work to create a derivative work or maybe a sequel, you know, in more common vernacular.
So, but Rania, this isn't breaking new ground. This isn't, you know, we don't have to create any kind of new framework to address these issues. The law is already there, and it's clear.
Yes, that is true. I think some of what is happening now is consumers are talking about it. Are we as consumers going to accept these AI-generated copies or movies or television shows or not? Are we as consumers going to accept AI-generated anything? I mean, this is really a kind of an existential threat. Almost any job, if you think about it.
But again, those are two issues, right?
Two
On the one hand,
issues.
We're not going to accept theft. If a company uses copyrighted material and doesn't, you know, follow proper procedures there, i.e. paying some kind of royalties to Sarah Silverman in this case, that's not okay. Correct. On the other hand, if OpenAI writes a new comedy special with without infringing on anyone's copyright, which I don't know how that would happen because they have to train the model. But
exactly. I don't know how that would happen either, because AI is only as smart as the information you provide to it.
That's a very good point.
So I'm not
I
sure
just talked myself into understanding what you were saying.
Glad to be of help.
So is there a sense, Ronnie, that the legal industry, I mean, hopefully they're going to do better than our regulators in Washington, but is there any sense that is there any academic work being done in the legal industry about how to look at this stuff from a legal perspective?
I think it's extremely exploratory. So just like any technology, some use of AI will be beneficial to all, and some of it won't. And in fact, you're likely using AI now without even knowing, right? Because it's part of a lot of systems that you're currently utilizing. And so I think there has to be some regulation around how to use it and when not to use it. And there should be also some contractual provisions that attorneys write. So I represent some celebrities and some influencers, and when we are working with production companies or others, they'll ask us to release the likeness, the tone, the image of the celebrity in perpetuity. In perpetuity, and in any medium known or unknown, or soon to be known.
That's a wide scope.
It's a very wide scope. So I think the attorneys, they have a power of a pen, and when the other side says this is a deal breaker, you should just take a step back and ask yourself, is it really a deal breaker, or can we carve out something to keep the integrity of the image of the person?
Any idea how this writer's strike will play out? Because I'm not sure Well, if I were a media company, I'd be saying, hey, guys, I'd love to give you a cut of the streaming revenues or whatever, but I don't know what they're going to be. You know, I don't know how this.
The economic side is unclear. I heard your interview yesterday with, I think she was the head of a guild.
Yeah, the Writers Guild.
And she, I mean, her insistence is that these streaming companies are just cashing in hand over fist and making billions and billions and billions in profits. But as we know from watching the market move every day, investors aren't sure about that.
No, exactly. So any sense of how this might play out? It seems like it could go on for a long time.
It can go on for a long time, but I think as more people feel the pain, there'll have to be some compromises. Right now, it seems like everyone has their dukes up, and nobody cares about the fringes. But this strike is not only affecting writers and actors, it's affecting so many other people in the profession tangentially.
It reminds me tangentially of the lawsuits we saw flare up over NFTs.
Yes.
And I wonder, did we ever sort that out? For example, Quentin Tarantino wanted to make an NFT, I think, of his script for Pulp Fiction, right? But the studio said, no, hang on a second. We own that script, even though he had the physical paper copy in his hand. So there were similar copyright issues coming up around crypto.
Yes, well, the copyright laws are the same. They're applied across the board. But again, a lot of this can be taken care of contractually, hence this strike. But here, neither side seems to be communicating very well, and that always ends badly.
All right, Ronnie, thank you so much for joining us. Lots of issues out there for you guys to figure out. Ronnie Sedholm, managing partner for Sedholm Law Group, joining us live here in our Bloomberg Interactive Broker Studio. Right now, let's get a checkup on those markets. John Tucker's got a Bloomberg Business Flash.
All right, major averages higher, but scaling back some of the earlier gains. The economy grew at a 2.4% annual rate last quarter, boosting hopes we can avoid recession. So far this earnings season, 80% of companies have topped Wall Street expectations. Meta Platforms jumping after the Facebook owner reported its highest quarterly sales growth since 2021. Dan Ives at Wedbush Securities weighed in on Meta's earnings.
This is actually digital advertising. That's starting to ramp back up to double-digit growth. They should have had Rocky 2 movie playing in the background during that conference call, because this is a Rocky Balboa-like comeback for Zuckerberg and Facebook. Just a huge, not just for Facebook, but also for big tech in terms of digital advertising comeback, a huge print.
NASDAQ 100 right now, 213 points higher, up 1.4%. S&P 500 up 23 points. That's up 0.5%, 45.89 at the index. And the Dow, 45 points higher right now, up 0.1%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, back in the studio. Paul Sweeney here with you. We are on that YouTube thing on the video. So just go to YouTube and search Bloomberg Global News, and that's where you'll find it. All right, C-suite conversation today. You thought that SPACs were kind of outdone?
Yeah.
They're still getting done out there, and we've got one coming up here. Derek Alberly joins us. He's a board member at LetterTech, and LetterTech is to go public via a prospector SPAC at a $348 million valuation. Derek, thanks so much for joining us on Zoom here. Talk to us about LetterTech. What do you guys do?
Well, thanks for having me, and good morning. In addition to being on the board of LetterTech, I'm also the CEO of Prospector Capital, the SPAC that has signed a business combination agreement with LetterTech. Look, at LetterTech is a super interesting company. It's in one of the largest segments of automotive software, which is ADAS software, which is projected to grow to about $42 billion by 2030. And we fundamentally believe that they have a leading position in a disruptive portion of that software stack. And as the market moves to kind of new architectures for ADAS, we're going to see more sensors in the vehicle and the need to scale. The architecture that's being used today is just not going to get there. So the industry is looking ahead to the next generation, and that's something called AI-based low-level sensor fusion and perception, and that's what LeddarTech has been working on. My background before Prospector and LeddarTech was actually a long time at Qualcomm, and as you likely know, they've had pretty good success in the last few years in automotive, and while I was there, we were planting a lot of those seeds. And, I've been very interested in this space for a long time, and we were very excited when we found LeddarTech and realized the leading position they were in.
So what's your experience? I mean, obviously very positive from your perspective in the SPAC wrapper, but do you think you would do it that way again?
Yeah, look, I think there's been a lot of puts and takes in the SPAC market over the last 2 years or so. We felt it very important from the outset to find a company that we could bring to the market at an attractive valuation, had a large market opportunity ahead of it, and fundamentally where we could help actually get that company through the transition to public markets and scale the business. And that's what we believe we found here with LeddarTech. And I think those are the types of deals that have performed well in the SPAC market. There have been some ones that have been less successful, but if you look back at the autonomous vehicle space, you look at the auto tech space, the SPACs have been a pretty effective vehicle at raising capital for these companies, over $2 billion raised, since 2020.
Why do you think, Derek, why do you think that SPACs have been so focused on the automotive industry?
Look, I think it's an industry where patience is required. I think, the adoption curve can take a while. And I think some of it's a little bit harder to digest just through a traditional IPO. But with the right sponsor group that understands the industry and is going to put the time in and take a longer view, these opportunities can be quite successful. And they've also it's been a good vehicle for raising capital post de-SPAC or IPO. There's been over $1 billion raised by these companies since then. So as we look ahead, this transaction will, bring the company to the public markets, open a wider variety of opportunities to fund the business as it scales into the future. And, I think that's exactly what they need to get to the next step.
Derek, just as you think about the autonomous driving technology, give us a sense of where you think it is right now in its development, and how long will it take to really become commercially viable for a lot of these big automakers?
Look, I think there's still quite a journey to get to full autonomy. But the thing that we really liked about LeddarTech and do like about LeddarTech is this is not a bet on when autonomous vehicles will be ready for commercial adoption. Their technology applies today to traditional ADAS systems in the cars, so advanced driver assistance systems. And through a combination of consumer preference and regulations that are being driven in the US and Europe, the adoption for ADAS, including entry-level systems, is forecast to really explode over the next few years. So their technology addresses a technology that's in the market today, but as it scales up to higher levels of safety and more sensors are needed, they have a huge advantage there. As well as automakers are pushed to put in ADAS even into lower level cars, you need to have a more cost-effective solution there. And their technology and software actually allows automakers to get 2 times the level of performance at 30 to 40% lower cost compared to what is in the market today. So it's potentially a very large game changer here for driving adoption of ADAS. And eventually, as we get to autonomy and the number of sensors on the car proliferates, their technology just becomes more and more valuable to the OEMs.
And Derek, just 30 seconds left here. Just when do you expect to close your transaction, and then just kind of how does that all look?
Yeah, so we've raised $43 million in PIPE capital so far. We're going to look to try to raise some incremental PIPE capital between now and close, which is, I think, we feel good about, given there's only been about $80 million of PIPE capital raised in the first 25 deals announced this year. And in terms of closing, we're looking at Q4 of 23, hopefully earlier in Q4 versus later.
All right, great stuff. Derek, thanks so much for taking the time to join us. Really exciting technology there, an interesting transaction. Derek Aberle, he's a board member at LetterTech, and he's also the CEO at Prospector Capital Corporation, doing a SPAC transaction with the acquisition or with the deal with LetterTech in the automotive business. All the sensors that are in your car now, that anytime you even think about changing a lane, you know, they got like all these bells blinking and things going on. So it's a different business, this automotive business. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Paul, Southwest is warning of higher than expected costs, and that's not helping shares. They're down right now, well, about 9%, and that's putting pressure on the carrier's earnings and countering its gains from a surge in early summer travel. Now, adjusted profit matched estimates, and operating revenue was in line with Wall Street expectations. Now, Southwest says leisure demand is strong, but business travel is still down. And American Airlines and JetBlue will not require government oversight as they unwind a partnership that flew too far. Bloomberg's Steve Rappaport has that story.
Lisa, a federal judge rejected the Justice Department's request for a third party to monitor the carriers as they dismantle an alliance that he said violated antitrust laws. Judge Leo Sorokin ruled the court can't implement harsh measures when less severe ones will do, and called on both sides to submit a revised version of the injunction by tomorrow. American and JetBlue formed the Northeast Alliance to compete more effectively in the New York City and Boston areas with rival airlines Delta and United. JetBlue opted to end its fight for the partnership, while American plans to appeal the antitrust ruling. Lisa?
And shares of American Airlines right now down about 1%. Well, United has become the first U.S. airline to add Braille to the inside of its aircrafts. About a dozen planes have been equipped with the special markings for those who are visually impaired. Now, for individual rows, seat numbers, as well as inside, outside of the restrooms, United expects to have them installed in its entire mainline fleet by the end of 2026. Now, shares of United right now down nearly 2%, and the Department of Transportation, it says about 27 million people with disabilities traveled by air in 2019. Those are the companies making news. I'm Lisa Mateo. This is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Looking at these markets here, still some green on the screen. S&P 500 up 0.4%. The Dow's pretty much unchanged here, up just at 21 points. NASDAQ is where the action is, up 0.9%, and even more so the NASDAQ 100 up 1.2%. So we'll keep an eye on that. We had a lot of earnings come out and continuing to come out. A busy day today on the earnings front. We'll stay on top of that. We heard from central bankers over the last 24 hours suggesting that they are at or near peak rates. The market is reacting to that. So lots for this market to digest. Right now, let's head down to Washington, D.C., get rolled in national news with Nathan Hager.
Paul, former President Donald Trump's lawyers are expecting an indictment as soon as today over efforts to overturn the 2020 election result. That is what sources are telling Bloomberg News as Trump attorneys John Laurel and Todd Blanche have been meeting with prosecutors from special. It's setting up to be the hottest day of the year in New York, Philadelphia, and Washington, D.C., and all about 170 million Americans are under some kind of heat alert today. Allegra Legrand is a climate scientist at NASA's Goddard Institute.
We have memories of when we were kids or even a decade ago when summers felt different. And climate change has finally hit that point where it's no longer in the range of what we're accustomed to.
NASA's Allegra Legrand, and it just so happens the White House is announcing new steps to protect Americans from extreme heat. They include a hazard alert from the Labor Department to reaffirm protections for outdoor workers. Later today, the president will meet with Italian Prime Minister Giorgia Meloni. The far-right leader has gotten praise from the Democratic Biden administration for her strong backing of Ukraine in its war against the Russian invasion. Meloni is also expected to privately detail her plans to back away from China's Belt and Road initiative. The counteroffensive appears to be intensifying in Ukraine. The Ukrainian military says its forces are pushing in two directions in the south to try to rip through Russia's fortifications. Russian President Vladimir Putin today said the hostilities have intensified in a significant way. He's been meeting with leaders of 6 African nations, promising them free grain. Russia has been pounding Ukraine's port infrastructure after ending the Black Sea grain export deal. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington, and this is Bloomberg. Paul and Matt.
All right, Nathan Hager, thank you so much. We appreciate that. You know, Matt, I don't know if since, you've been away, probably a couple of weeks ago, I officially took the recession talk off the table.
Oh, yeah?
For me. Now, obviously nobody cares, but I thought I'd share that with you. But then we got the economic data today. And I don't know, U.S. growth accelerates. GDP, 2.4% on resilient consumers and companies. Household spending tops estimates. Business investment, robust.
It looks great.
It looks pretty darn good.
It looks very good. In the back of my mind, I keep thinking about the Jeff Sherman warning that we got a couple of days ago. He's over at Double Line Capital, and he is warning that there's going to be a deep recession, a dramatic recession that merits a 1 percentage point interest rate cut by the Fed in 2024. Actually, could be even more than that. So he's moving out the curve and buying bonds between the 10s and the 30s. And he's an outlier there, but he's a smart guy.
He's a smart outlier.
And it's a smart shop.
It is. It is. So, I mean, that's what makes a market here. So, we'll have to see. But, I mean, I think the consensus, up until recently was if there's going to be a recession, yeah, okay, but it'll probably be mild, probably be relatively short. Now some folks are literally kind of just saying, boy, you look at some of this economic data that we got today, I just don't see it.
Right. And yet the yield curve is inverted drastically. And one of the smartest people in academics has proven in the past that leads to a recession. You know what I'm talking about?
I do. Cam Harvey, my former professor at Duke. I passed his class, thankfully, but it was a grind. This is Bloomberg.
It was a grind.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, folks, coming up in this hour, Do Not Fight the Fed. Cam Harvey, finance professor at Duke University and co-author DeFi and the Future of Finance. He's going to join us here to talk about what the central banks have been saying over the last couple of days and what maybe look forward to coming up. And then we're also going to have a discussion with, hold that back, who was that? Oh, yeah, simulcast. How good is this going to be? Meta CFO Susan Lee is going to join Bloomberg Technology for post-earnings discussion with Ed Ludlow and Caroline Hyde. So that'll be later on in this hour. So that's going to be good because Meta just blew it out of the water.
I mean, they made $32 billion in revenue. They made almost $8 billion in profit from essentially ad sales. Like, it just shocks me.
Exactly. I started off covering the media industry when newspapers and magazines were the thing. Now it's this intraweb thing. So how times have changed. All right, all that's coming up. We'll get to it. But let's kick things off with a Bloomberg Business Flash. Denise Pellegrini.
Yeah, it's 12:01 on Wall Street. And Paul, do they give you a commission every time you have someone from Duke on? Because
they should.
They're all good guests, though, right? And we do have signs of economic strength overall on Wall Street, so I guess we can afford to pay them. The Dow, it's higher, along with the NASDAQ and the S&P. And, you know, if the Dow closes higher today, some are saying that would be 14 trading days in a row, of course. That hasn't happened, some are saying, since 1900. I got to look that up on the Bloomberg terminal, but if that's true, that's wild. Many investors betting the Fed is getting ready to wrap up the rate hikes again. And Richard Clarida, he's global economic advisor at PIMCO, says the Federal Reserve intends to end its current round of interest rate hikes soon.
Whatever hiking they think they need to do, I think they want to get in this year. I think they think they're close to the end anyway, and inflation's moving, however, slowly in their direction. And I think they would like to stay out of the spotlight in an election year. Now, we've had the Fed hike in election years, 04, 1984 come to mind, and they'll do that if they really think that inflation really requires a much higher rate path. But I think this cycle is aiming to finish up sometime in the fall.
All right, so that's Clarida there on the Bloomberg Surveillance podcast. We do have a bunch of other headlines on the economy. Stronger than expected second quarter GDP. Signs the labor market is weakening. That's easing concerns about more rate hikes. In the housing market, that surprise gain in pending home sales. China urging improved mortgage rules to support housing market. And we're also watching top U.S. bank regulators because they unveiled plans today for a huge overhaul for bank capital rules. The Dow, it's higher, better by 14 points. That's just fractionally. The S&P 500 up 21, about 0.5%. The NASDAQ up 143, the big winner of the day, more than 1%. The yield on the 10-year creeping higher over yesterday, 3.94% now, we'll call it. Spot gold, it's lower by 1.3%, 1946 an ounce. Crude oil, the big story you guys have been talking about, it's at the highest level since April, up 1.5%, just slipped below 79.96 a barrel, but we did see 80 earlier in the day. And that is a Bloomberg Business Flash, guys. Back over to you.
All right, Denise Pellegrini, thank you so much. We appreciate a lot going on here. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're streaming on YouTube. Check that out. We got...
Well, you got to tell them how, because the thing is, I go to YouTube and I look for us, and I don't know how to find it.
You go to YouTube. That's the interweb. Okay,
I know.
And then you go to a little search button. You say Bloomberg Global News, and that brings you to
So that's the key. You've got to search for Bloomberg Global News. And by the way, I have no idea why. I would never just randomly type Bloomberg Global News into the search bar, right?
Right.
I would type Bloomberg Markets. I would type Paul Sweeney.
Right.
You know, but you got to type Bloomberg Global News.
All right, talk to the YouTube people about that. I don't know what's going on. Anyway, Barry Ritholtz joins us for the next hour. Barry Ritholtz, he's got this podcast, Masters in Business, on Bloomberg. It is awesome. He's also the founder and CEO of Ritholtz Wealth Management. They manage some money over there. We're going to get to Barry in just a second. But first, I want to go to Abigail Doolittle. She covers the markets for us. Just going to get a couple highlights, what you're seeing out there, Abs.
Well, I think that while we have the Dow up ever so slightly right now, less than 0.1%, we have to mention the fact that it's now up 14 days in a row, something that we've never seen over the last 123 years. And I think that the point we really want to make around this is that this year's rally is perhaps starting to broaden out just a little bit away from the tech. And then beyond that Dow fact, you know, it's still Meta. Meta is strong. It's off the highs. It's up 6.7%, but the revenue growth really impressive, double digits as opposed to a high single digit. And again, for this quarter, the outlook is calling for 20% growth, basically a doubling of what the last quarter was. Ad growth, ad sales coming in strong. You know, a real likeness there between Google or Alphabet and Meta. Now, the big one is next week, Apple. So Microsoft kind of just hit numbers. They stayed in that high single-digit revenue growth. What's Apple going to do? Now, the interesting thing on Apple is for the quarter that was, revenue is expected to decline 2.5%. So is that a low bar, or is that going to be a little bit of pain next week? We simply don't know right now.
Apple stock up 50% year to date.
It's incredible.
Yeah, so
the rally for all of these.
Yep. So I don't know. I think I guess this thing's broadening out, right? I mean, I like the Magnificent Seven. What's wrong with the Magnificent Seven?
Yeah, no, nothing.
That's plenty.
You know, if in the Bloomberg terminal, if you use the SPXL1 index GRR function, this gives you the ranking of the sectors on the year. So if you had done this a few months ago, there would have only been 3 sectors higher, the 3 mega cap tech sectors. Now you have 8 sectors higher: consumer staples, financials, real estate, materials, industrials. So it really has broadened out. Lagging utilities. That's actually a bullish thing because that is a defensive sector. Those dividends look less attractive as yields go higher.
And energy is also a laggard, but
it is.
You got to think is going to change.
Yeah,
we
you have
see
to
crude
think that's
oil
gonna
marching
flip.
up through $80 a barrel. I mean, NYMEX.
Well, is that a temporary move up in response to what's going on in Ukraine and some of the recent changes in the war, or is this start of a new upward trend in energy prices?
Let's take a look at the chart, Barry, because there's a very strong.
That's Barry Ritholtz, by the way.
By the way,
needs no introduction.
There's a very so it's breaking out of the range. It's been in a range, a downward range over the last year. It is right now breaking out of it. So it's a very legitimate question. It could go significantly higher. And if energy does turn higher on the year, last year and the year before, it was up a combined more than 100%. So not so shabby.
All right, great stuff. Abigail Doolittle, thank you so much. We appreciate it. Abigail covers all the markets for us. And as we mentioned, Barry Ritholtz joins us here in studio here.
We got something to talk about with Barry. Not now, but a little bit later, because the Land Cruiser could be coming back.
The Land Cruiser could be coming back.
That's
and that
60 grand. Not a bad looking truck.
All right.
60 grand?
Yeah.
That's so much cheaper than it was priced when it went out.
Stop.
All right, we're not going to talk about it.
Stuff to
We're not
talk about
gonna
here. Sorry, we got somebody important on the line. Cam Harvey, he's a professor of finance down there at the Duke University. All right, let me explain to you how this works at Fuqua when I was there. Here's the grading system: pass, high pass, superior pass. Anything below pass, you don't want to talk about. Yeah. Now, in Cam Harvey's class, futures and options, I don't know what it was. It was something very hard. I can say with great confidence, I probably did not get a superior pass.
No.
There's chance I got a high pass, but if I had to put money on it, I'd put it pass.
Yeah.
And that's okay.
Well, and you're not an economist.
And what we said
we
back
still
in
have
the day,
questions to ask him.
We still have questions. What we said back in the day is 20 Ps, 20 passes equals 60 Gs, which was the going rate on Wall Street for an MBA. So all you had to do is pass.
That's a really materialistic way to look at it. That's your generation.
That's
on Wall
my
Street.
generation because I played golf every day. Hey, Cam, Professor, thanks so much for joining us here. What did you take away from? Boy, we had a lot of central banks speak over the past couple of days with the ECB this morning and the Fed yesterday. What are you taking away from some of these central bankers?
That they fundamentally are misjudging the inflation threat. It is shocking to me that you just need to look at the data. Look at the most recent inflation release, which was 3%, and actually the more precise number was 2.97%. And if you look at the drivers of inflation, the main driver is shelter. So shelter is a little over 1/3 of the CPI. And shelter is running at 7.8%. So let's do some really simple math. The contribution of shelter to that 3% print is about 1/3 of 7.8%. And that comes to about 2.6%. So almost 90% of the inflation print was shelter. And shelter is not running at 7.8%. So you look at the data, you look at rents year over year, you look at housing prices, it's close to flat or 1% or 2%. And it's because shelter lags. So that 7.8% is reflecting stuff from 6 to 9 months ago. If we use the real data, the inflation is not 3%, it's 1.5%. And it seems to give the reason that, oh, well, inflation is still there, it's 3% and it's not 2%, it's a false logic, a totally false logic. So this increase that the Fed just did was completely unnecessary. It increases the risk in many different dimensions that we are pushed into an unnecessary recession.
So, Professor Harvey, this is Barry Ritholtz. Let's pretend I'm in your class at school and I want to argue this proposition that not only have we seen homes underbuilt since the era in the financial crisis, but the Fed raising rates as aggressively as they have are actually making owner's equivalent rent and apartment rentals more expensive. They're forcing people who would otherwise be home buyers into the rental market. What's the number? Something like 61% of homeowners with mortgages are at 4% or less, and they don't want to pay 7.5% or more for a mortgage. Is the Fed too tight already? Are they accidentally driving owner's equivalent rent and CPI higher?
Yeah, so Barry, great points. And you just need to look at the data. So if you go to Zillow or Redfin, you see that rents year over year are running at 1%, 0%. They've been in the negative territory. There's a big disconnect between what people are paying and what is in the actual CPI. And we've seen this before. This is not new. This is the mistake the Fed made initially in thinking that inflation was transitory, that the numbers that we're using for owner's equivalent rent were really, really low when we could observe in the market that it was much higher. And there's a reason for these lags. So the lag makes sense. So if there's rental inflation, for example, it goes up by 10%, well, that only hits you if you have to have your lease renewed. And many people have a longer lease. So that 10% inflation wouldn't be realized until you actually renew your lease. So there's a natural lag. And my point is that this component, which is driving 90% of the current inflation, that is going to head down. It just takes a while. And again, this is very similar to what we saw with the so-called transitory inflation, that inflation is substantially mitigated. And the other point that you're making about increasing the rates causing problems, it's like two-sided. So those that have mortgages that are really attractive, you're correct. That is the disincentive to move. And it does put pressure on the rental market. But again, looking at the data, we don't see that rental inflation. We saw it go up, but now it's down, and that portends the future. And again, it undercuts very substantially the Fed's logic.
So,
and yes.
So, Professor, does this mean that the Fed is going to push us into a recession? And I want to bring in also your yield curve inversion to the discussion, because I have in front of me the 3-month, 10-year yield curve. We're looking at an inversion of 150 basis points, basically. And I was talking about Jeff Sherman from DoubleLine earlier. He thinks that signals a deep recession, and he's very concerned about it over there. Is that fair, do you think, when you look at the history of this yield curve inversion? Is it a good signal for a recession?
Yeah, so as you know, this is my dissertation at the University of Chicago. And at the time, pretty good it was like 4 out of 4. Now it's 8 out of 8 without a false signal. And we've had this inversion that is like 10 months inversion.
And without a false signal is an important clause, because Rick Reeder was on with us the other day from BlackRock, and he said the yield curve inversion has forecast 9 out of the last 3 recessions or something like that. But I think people look at the 2s,
totally
10s.
False statement.
Yeah.
Yeah, it's totally false. And of course, you need to, there could be a part of the yield curve that you choose that's got a lot of false signals. I'm talking about what I chose, the 10-year minus 3 month, and that doesn't have any false signals yet. Of course, it could be a false signal, but it's too early to declare a false signal. The lead time varies, so that's not consistent. So the lead time has been as short as 5 months and as long as 22 months. So it's too early to tell. But again, let's not just look at the signal, but look at the economic logic as to what is happening. When you severely invert the yield curve, and when you invert it in a way where short rates and long rates go up, then you are stressing the financial system. So an inverted yield curve is bad for banks because it hits profitability, because they're paying a short-term rate and kind of receiving a long-term rate. But when that longer-term rate also goes up, that hits the balance sheet also. And we've already seen this play out in March in terms of some banks failing. So this puts stress on the financial system, and it creates other issues in addition.
So, Professor, given how rapidly the Fed has been raising rates, and given that we've spent so much time at zero in the last moments we have, how impactful has that rapidity been to this inverted yield curve?
Yeah, so the scale of the inversion is unprecedented in the data that I've looked at. So of all of the inversions, this is number 9. This one is the largest relative to the long-term rate. So we're in an area of the data that we've never seen before. And on top of that, the Fed has pushed very quickly. And in January, I said, given my look at the shelter data in inflation, they should stop. They did not stop. And what they're doing is just increasing the risk of a hard landing. It seems their calculus is unemployment has to increase. Right. People have to be thrown out of their job. That is not necessary. We don't need a recession.
All right, Cam, thank you so much for joining us. Campbell Harvey, he's a professor of finance at the Fuqua School of Business at Duke University. I appreciate getting his thoughts here on the central banks and on the inverted yield curve. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Good afternoon. Comcast beats on profit even as internet and TV subscribers fell due to cord cutting and wireless competition. Earnings increased 12% from a year ago earlier, and revenue topped expectations. Price hikes for faster broadband connections earlier in the year and an equipment upgrade offer certainly helped as well. Shares of Comcast currently up more than 6%. McDonald's is still bringing in diners despite higher menu prices and tightening consumer budgets. Bloomberg's Gina Cervetti reports.
Its key sales metric rose almost 12% last quarter. In the U.S., McDonald's benefited from price hikes and rising guest counts. Profits and sales beat Wall Street estimates overall. Its U.S. delivery service also grew.
Thanks, Gina. Shares of McDonald's up more than 2%. Anheuser-Busch has laid off hundreds of workers at its U.S. offices after months of slowing sales over at Bud Light. The company tells the Wall Street Journal the cuts would affect less than 2% of its 18,000 workers in the U.S. The layoffs won't impact frontline employees like brewery and warehouse staff. Instead, corporate and marketing roles at offices, including St. Louis, New York, and L.A. Amazon.com is cutting hundreds of jobs in its grocery division. The Washington Post says the layoffs affect zone leads who manage sections of individual Amazon Fresh stores. Amazon has about 44 of the Fresh stores in several cities nationwide, and it also owns Whole Foods. Right now, shares of Amazon are up more than 2.5%. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets with Paul Sweeney and Matt Miller coming up right after this.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 12:21 on Wall Street here on Bloomberg Markets. I'm Denise Pellegrini. We check the markets all day long for you here at Bloomberg. Stocks are solidly higher. Many investors betting the Fed is getting to wrap up those rate hikes. But PIMCO's Daniel Ivaskin, he says it is dangerous, guys, to think the Fed is done. But it seems people are kind of ignoring him today because, as I mentioned, stocks are higher. We also have those stronger than expected second quarter GDP numbers, but some signs the labor market is strengthening as well. So that's another issue that could indicate more inflation around the corner. And in the housing market, we have that surprise gain in pending home sales for June. And that is thanks to strength in the Northeast and the Midwest. The Dow right now up 70 points, about 0.2%. The S&P 500 up 0.6%, 26 points. The Nasdaq up more than 1.1%, 159 points higher right now. The yield on the 10-year, 3.95%. COMEX gold, it has been lower all day, down about 1.4% now, but it's the opposite picture for crude oil. Crude hitting the highest level since just about April. NYMEX crude up 1.70% and above $80 a barrel. Top U.S. bank regulators, meantime, unveiling plans for their most comprehensive overhaul in capital rules in years. And that could force large lenders, if these rules are finalized, to thicken their financial cushions to absorb unexpected losses. And of course, that kind of pours a little bit of cold water, guys, on all the stock buybacks that we saw, like Wells Fargo the other day. And that's a Bloomberg Business Flash.
All right, Denise, thank you so much. Denise Pellegrini there with that Bloomberg Business Flash. Let's get right in with our next guest, Dan Genter. He's the CEO and CIO at Genter Capital Management. So, Dan, a heck of a start to the year in these markets. Certainly a lot better than 2022, where you just couldn't escape the carnage here. What are you telling your clients here as you kind of parse through what we've heard from the central banks over the past couple of days, as we parse through earnings here? What are you telling your clients here about what they need to be doing in this market?
Well, I think the real key here is just to stay diversified. I mean, we've had a very, very narrow market this year. I mean, literally, the Magnificent Seven have been about 80% of the total return. It's been a complete reversal of what you saw in 22. So I think it's very, very important right now that clients really don't just follow that pathway of looking at only that momentum. Certainly, you can have these companies as a portion of your portfolio, but I think more than ever is to stay very diversified. And frankly, with what we're seeing, you know, with the overall strength in the economy, I mean, certainly the numbers in the revision today was very unexpected by everyone. You know, the pushes, the things that we're having in inflation, how sticky that is, you're very, very likely that you're going to have some multiple rotation, and we're starting to see it, that the value type companies, the lower PE companies, the market is broadening out, fortunately, in this rally, and we think that people should stay very broad and search for some of those values right now. It's really going to be a stock pickers type of market, not just following a very small, select number of stocks.
Hey, Dan, Barry Ritholtz here. So let me ask you about diversification. How far does that extend? Do you look overseas where equities seem to be a little cheaper than they are here in the U.S.?
Look, I think that certainly there's some values that you can look overseas and you can see, you know, some of the stocks that we're buying, you know, certainly fit into that category. I think in the same vein is that you have to really look at it on an individual stock basis. I mean, and the inflation that we're seeing in Europe actually is not as under control as what we're seeing already in America. They're a little bit behind the curve. You know, they're dealing with even some additional problems with regards to continuing supply shortages. I think that the value is in a number of different places. I mean, there's places in the Far East you can look. There's places certainly that you can look in Central and Western Europe. But we're seeing, frankly, a lot of value here in our international companies and our multinational companies, frankly, companies that, you know, they were just left behind in the first 6 months. And so to be in a position where you can now find these companies that are selling at significant discounts, you know, knowing that, look, the data that we received today is just confirming that we're going to see higher interest rates for longer, and that some of the potential credit crunch, which may be the next shoe to fall, is going to have effect on some of these companies that are not quite as strong, that are a little more leveraged, and finding these companies that are, you know, that are much more fundamentally strong companies with good balance sheets, good earnings, good dividends, you need to be diversified in these companies, or I think you're going to miss out on some of the rotation.
Sorry. Let's talk about some of the companies that you like. And CRH, I think, is an interesting one to start with because it's a big maker of, infrastructure products that is very untech, right?
It's about as basic can get. I mean, it's literally they're a cement and aggregate company that's been doing it since 1936. They grow their pricing consistently at 5% a year. They've been doing it, for over 50 years.
And they're international, right? It's an Irish company, right?
That's correct. They're Irish. So that's one of the companies that that y'all were referencing. Is that here's an international company. They're headquartered in Dublin. They're traded there, and they're traded in London. It's also a big part of the story because now in September they're going to list here in America, and and trading where they are at about a 14 PE, they're at about a 40% discount. From what you're seeing in the companies that are here. And they're going to be a major beneficiary of governmental spending. The U.S. Infrastructure and Jobs Act, the Inflation Reduction Act, the CHIPS and Science Act, all of these, government programs, the spending in core infrastructure, road building, bridges, et cetera, is right down their alley. It's going to benefit them directly.
And I see you also like Chevron. We saw oil run up through $80 a barrel today. What's your thoughts on Chevron in particular and the entire energy sector?
Well, it's been a sleeper so far this year. And as you just mentioned, we're over $80 a barrel. It's slowly creeped up with, frankly, very little fanfare because everything was on the back pages compared to AI. And now you're over $80 a barrel. This basically is going directly to their bottom line. They're still trading at about a 12 PE. You get a 3.7% dividend while you wait. And the fact of the matter is that the rumors of the demise of fossil fuels has certainly been exaggerated. We're at bumping on all-time highs with world consumption at 101 to 102 barrels a day. That's going to creep up. We think by 2026, that's going to be 105 or 106. Million barrels a day. And so you're going to continue to have positive pressure on oil from here, and that's going to flow directly to the bottom line for Chevron that's frankly trading at a significant discount to the market right now.
Yeah, down 7% year to date. Surprising.
Yep. All right, so V as in Victor S, CVS, not to be confused with my old company CBS that I covered. CVS, healthcare. What's the call there?
Well, look, healthcare was a darling last year and did very well. And now this year it's been under a lot of pressure, mainly because of verbiage that's coming out of Washington. As you go through that cycle of beating up on the healthcare companies, prescription drugs, whatever, the whole sector gets taken down. CVS started to do a very aggressive vertical integration program several years ago. They're executing on it extremely well. They're still trading at a significant discount to the market, about 55% of the market at a 9 PE. You're getting a 3.2% dividend while you wait. And we think that they're going to grow basically high single digits to low double digits for the next 2 years, and that the stock is significantly undervalued.
All right, Dan, thanks so much for joining us. Always appreciate getting your market perspectives and some of the names that you guys are trafficking in at the moment. Dan Genter, he is the CIO and CEO of Genter Capital Management. So good stuff there. I'm looking at Meta Platforms, stock up 6.5% today. It's up, year to date, 164% year to date. Still got some work to do to get back to its all-time high, but just having a tremendous story. The story, since almost the beginning, was a revenue story, a top-line growth story. And then it became a cost story as Mark Zuckerberg focused on cutting costs. And that was great for the stock. It's now become, it seems, after this quarter, once again, a revenue story. So we're going to break that down. Meta CFO Susan Lee joins Bloomberg Television for a post-earnings discussion with Ed Ludlow and Caroline Hyde. Let's listen in right now.
Audiences worldwide. We want to dive even deeper into Meta's earnings report. CEO Mark Zuckerberg saying, look, quote, we continue to see strong engagement across our apps with the most exciting roadmap I've seen in a while. Our investments in AI will continue, and we remain fully committed to the metaverse vision as well. Let's dig in further with Meta Chief Financial Officer Susan Li joining us. And it's not just Mark finding things exciting. Investors, analysts upgrading, exciting economy for the world at large today, it feels, here in the United States. How excited, Susan, are your clients right now? How resilient is this digital ad spending?
Well, first of all, thank you, Ed and Caroline, for having me. It's a pleasure to be with you guys and with your viewers this morning. You noted that we reported really strong Q2 results. We're really happy with all of our execution efforts across our core user and engagement metrics, obviously the re-acceleration in our ad revenue, which we've been talking about, and which we think is the reflection both of an improvement in the macroeconomic landscape, which the digital ads market is so closely tied to, along with our own efforts continuing to invest in and execute on quarters and years of work in making sure that our ad systems are performing well, that we're delivering measurable results for our advertisers, and we really have seen those results bear fruit. So that's something we're really excited about in Q2. We also talked about how our year of efficiency work is really setting us up for success going forward. I think it's put us into a place where we have a leaner cost structure, which will serve us well as we plan for the future. And it's also enabling us to move faster, to build more and ship more quickly new products and experiences in service of our customers. And so Mark talked about this yesterday on the call. Threads is a really good example of that. It's something that we built with a relatively smaller team on a tighter timeline, and I think is a good reflection of the year of efficiency paying off for us. Finally, the last theme I'd highlight from our earnings call is around 2024. We have, I think, a lot of compelling opportunities to invest in. We talked about our AI investments and how that will flow through into infrastructure costs. We talked about hiring top-tier technical talent as we evolve our workforce towards a more technical mix. And then, of course, our longer-term ambitions and vision for Reality Labs and for the metaverse.
AI also seems, Susan, AI recommendations on the timeline to have a real impact on engagement, particularly on the core Facebook platform. How much is that a driver behind the forecast for the current period of $34.5 billion in sales?
It's a great question. First, I want to say we have been investing in AI for a really long time. We often use the phrase core AI to talk about the work that's been powering our ranking and recommendations engines, which are really the foundation of both our organic recommendations for the content that you see, along with the ads work. And in particular, one of the big drivers of growth that's been both strong on our platforms and increasingly incremental is around recommending content from accounts that you don't already follow. We often call this unconnected content, and that's been really good for core engagement trends. And then, of course, the AI investments, as we put GPU capacity towards our ads, ranking, and recommendation systems, have really paid off. So I think that's really translating both into the results that you've seen. It's part of what factors into our guidance, along with, of course, a big range of possible macroeconomic outcomes. At the same time, we're really excited about a newer opportunity ahead of us in the Gen AI space, and that's really around building compelling new consumer experiences. Mark talked about some of the things we're working on the call yesterday, making it easier for people to create better, more individualized content, and then, of course, also making it easier for businesses to communicate with the consumers that they want to reach. That is newer for us. That's not factored into our revenue guidance or our revenue outlook, in any meaningful way. But it's something that we're really excited about, the opportunity to build new and compelling experiences, and we think it'll be an important part of our future.
Susan, why did Meta change its mind about charging cloud providers for access to Llama 2?
I'm not sure what you mean by changing our mind. We've made Llama 2 free and widely accessible. There are a small handful of really large cloud providers that we're working on specific arrangements with, but broadly speaking, we expect this to be free, and we want it to be accessible to a really wide range of possible use cases.
Cloud providers, will they be charged anything?
This is a place where, again, with very specific cloud providers who have very large user bases, again, we're working on specific arrangements with them, but it's not something that we broadly anticipate charging for.
And of course, we're all waiting to see when you turn on the money funnel from Threads. I'm interested as to how much inbound you're getting from clients. How many want the capacity to start advertising alongside Threads at the moment?
You know, we're really very pleased with Threads. It's a new standalone app that, you know, we released earlier this month, and we're where it is in both user growth terms as well as engagement and retention trends is certainly ahead of where we would have expected for a brand new standalone app. But it's incredibly early in its life cycle. This is not something that we expect that we're going to monetize in the near term. We know when we launch new consumer experiences that there is a playbook around all of the product foundation work that needs to be done around core features that users will ask for, being responsive to things that users are looking for in the product, scaling it over time to a much larger user base, focusing on driving increased engagement and retention. Those are all things that we're going to need to do, you know, in advance of thinking about monetization. But it's a playbook that we've executed multiple times, and we're excited for the opportunity to do that again here.
Susan, I think I'm right in saying you were Facebook employee number 400 and something, 408. How has the launch of Threads compared internally to bringing in Instagram, WhatsApp, the launch of the hardware business in Quest?
So I joined then Facebook back in 2008 when there were around 400 people here. And so I've seen us launch a lot of things over the course of that period. Now, some of those examples that you mentioned, like Instagram, obviously were already popular apps when we acquired them. But I think that over the course of that time, we've learned a lot of things about how to bring products to market, thinking about the trade-offs between standalone apps or features within existing apps. We've learned a lot in our growth playbook and how to drive engagement and retention. And I think we're going to bring a lot of those lessons to the way that we execute against our vision for Threads.
Caroline asked you about the inbound interest. Your existing advertisers saying, hey, Susan, when can I put something on the Threads platform? I know you're being conservative and careful about the development, and that Mark emphasized a lot of product work needs to be done as well. But how do you see the roadmaps for Threads going? You know, how do you change the product so it is monetizable?
Well, we're excited, obviously, that there is interest both in Threads, the consumer product, and of course, the eventual prospect of advertising on it. But it's really just too early, I think, to be very specific about what the ads business on Thread will look like in detail. We're really focused on executing on the consumer experience first, making it a great and productive and friendly place for people to have public conversations, growing it to scale, investing in the features that people want, and we'll get to monetization at the right time.
Of course, us in the media had a field day thinking about the competitive force that Threads is vis-a-vis X, and then we think about the competition more broadly, you versus TikTok, when I'm thinking of the success of Reels of late, when we're actually more broadly thinking about how Meta makes it self, not just a money spinner, but a culture spinner here, where people start trends, not just perhaps copy them from TikTok and bring them on to Reels. Do you feel you've got that now at Meta?
I think that we've been, over the course of the time that I've been here, you know, constantly focused on innovation. And I think that we've brought that to bear with a lot of the experiences in our family of apps. And at the same time, when there are clear secular trends in the industry in terms of formats or experiences that consumers are looking for, we look to integrate those too. And I think we've done a really good job at executing on both of those fronts. And then, of course, looking forward, I think we're really excited about the innovation opportunities ahead of us with Gen AI. We think we're industry leading here. And then, of course, over the very long term with our vision for Reality Labs and the metaverse.
We are, of course, with the Meta Chief Financial Officer, Susan Li. We're welcoming her across TV and radio with our audiences. And Susan, everyone started talking about everything apps. Now, I know you're about the money, not always developing the product. But do you think about everything app as Meta? Is there a race on to ensure that we can build that here in the US and you'll be part of it?
It's a great question. I know that there are other regions around the world, in particular Asia, where there are apps that have gone down this model. That's not a model that we have right now. We haven't seen that use case to the same extent in North America. But, I would say that we're really invested in the opportunities that we have ahead of us across our family of apps right now, including Threads, which is the newest standalone app in our portfolio. And then there's just a lot that we can do to make the experiences across our family of apps richer and more engaging with the investments that we've made already in AI, and especially recommending content that you don't already follow. And we know that that's brought richer content experiences to people, is growing engagement across the apps. And we'll release, we'll be releasing features over the course of the next years, but we're really excited about what we think that this is going to bring to bear for the consumer experience, and of course also eventually for businesses to connect with consumers across the family of apps too.
Susan, investors were sanguine about the idea that expenses could creep up. I wonder if you just tell us what your priorities are, where you'll invest in talent, in the metaverse, whether your investments will be on the content side or the hardware side.
Great question. We talked about this a little bit on the call yesterday when we gave some color into the 2024 outlook. The three themes that I really want to talk about there are, first, we expect that our infrastructure costs are going to grow because of the investments we've made in AI, building GPU capacity, that will go towards both the core AI work and the ranking and recommendation engines that I talked about, along with the new Gen AI investments. So that's a place where we're investing certainly in a lot of hardware, along with the infrastructure, such as data centers and network equipment that you need to support that. The second area that we talked about is we are evolving our workforce toward a more technical mix, and we want to hire top-tier technical talent where we can towards some of our most compelling opportunities, including AI and machine learning engineers to work on the AI efforts we talked about. And so that's a place where we are going to be investing, but we're going to be doing it in a very thoughtful way, making sure that we're really focusing on the core priorities and making trade-offs where appropriate.
Susan,
the third thing that we talked about is on the Reality Lab side. That's certainly a very long time horizon and ambitious vision, and we're going to be investing and deploying capital toward it.
The capital coming from that you already have, are you looking at the bond market? Are you looking at raising more funds?
We certainly generate enough free cash flow right now for us to invest across the organic opportunities ahead of us that we see that are compelling. We have been raising debt. We did earlier this year, just as we're evolving our capital structure going forward, and that's something that we'll continue to look at and I think do on a measured pace going forward. But in terms of thinking about the capital available to us now, we generate a lot of capital that we're always looking to allocate across the organic opportunities that we have, and we've talked about some of those, and then of course shareholder returns.
Susan, really quickly before we lose you, how do you and Mark split up responsibilities at the company? What's it like working with Mark?
I've had the privilege of working with and learning from Mark for 15 years here. Obviously, as CEO, and as a product visionary, he really shepherds the product roadmap and has defined the long-term vision for a lot of the things that we're investing in with incredibly ambitious goals. And I think that's a tremendous and powerful motivator for us. And I try to make sure that we have the financial frameworks and targets that are going to enable us to invest against those things. Innovation isn't free, and that's something that we're very mindful of. And we recognize that, especially against some of our longest time horizon ambitions, we have to earn the right to put capital towards those things in the way that we do. What I will say, having worked with Mark for such a long time, is he's tremendous at adapting to the time that we're in. And so whether that was leading a 400-person startup when I joined, whether that was overseeing our transition to the public markets during the shift to mobile, or whether that was this past year helping us really retool our cost structure and the way we operate and leading on the year of efficiency, I think Mark is tremendously good at making hard decisions, at acting on them with conviction and looking forward.
Meta Chief Financial Officer Susan Li, thank you so much for your time. This is Bloomberg Technology.
All right, that was Meta CFO Susan Li sitting down with Bloomberg's Ed Ludlow and Caroline Hyde. talking about what was a pretty darn good quarter. The Street like it. Stock's up nice this morning. Mandeep Singh joins us. He's a tech analyst for Bloomberg Intelligence. He follows Meta and all those social media companies. So Mandeep, the stock market investors, they like what they heard last night. Why?
Well, I think you heard it from Susan as well right now that they are really going into high gear when it comes to investing in AI and what AI has done for them on the product side specifically. I mean, impressions growth of 34%. Coming from behind on the Reels, which was a product, everyone thought they would never be able to catch up to TikTok and YouTube. Well, that's what they've done, essentially, $10 billion run rate business. Wow. When TikTok clearly had a 2-year head start. And look, I think to an extent, it cannibalizes their existing ad inventory. So that's what is also reflected in the numbers, the ad pricing going down by 16%. But in social media, it's all about engagement. And what they have shown time and again is they'll figure out a way to either copy the features that someone else has or, do it on their own in terms of adding a new app or something. And that's what drives engagement.
So let's talk about copying some features. They, to great fanfare, rolled out Threads, their Twitter clone, which Elon Musk threatened to sue. I don't know whatever happened with that lawsuit or if it went away. Is this something that has potential to be a real revenue driver? Because Twitter feels like it's circling the drain, and I've been an active Twitter user since 2009, and in the short time that Elon has owned it, it's no longer has that sort of magic that it used to. Can Threads genuinely be a threat to Twitter the way Reels has become a threat to TikTok?
I wouldn't be surprised if they are able to build a business out of this the way Twitter wasn't able to do it. And the reason I say that is, one, yes, they had this 100 billion signups in week 1. But what they're doing gradually...
100 million.
100 million.
Yeah.
Yes. And look, I think they've got a list of features. So Susan Lee actually alluded to it, that they are looking to add new features. I think one of the top features is a desktop app. Then you're talking about...
Why launch without that? It sounds like they came to the party unprepared.
Well...
They're like, hey, you know what? Let's launch this thing. We spend $90 billion a year on the metaverse, but let's do no research at all into preparing this product.
They said Threads was built by a very small team within Meta. So that's the other thing. Despite 20%, 25% layoffs at the company, they were able to use a small team to build this Threads app, and it seems to have worked. So that just goes to show what kind of leverage you have in this business. You don't need a lot of people.
That's the really fascinating point, because Musk, in what can only be described as a future business school case study, spent $44 billion on Twitter, and might as well have lit it on fire.
He doesn't care.
You get Facebook with a few dozen developers taking 100 million potential subscribers in a week.
But what
That's amazing.
about they must have many dozens more working on the metaverse. Otherwise, they wouldn't project 88 to 91 billion dollars in spend.
The good part is the infrastructure, and I think that's where the infrastructure is shared across their family of apps. That's what gives them the scale.
There you go. Mandeep Singh, man on the spot. He's our senior tech analyst along with Anurag Rana. I don't know. These guys are smart. But anyway, he's been all over this stuff. Mandeep Singh from Bloomberg Intelligence. Meta stock up 6.5% today. So the market liking what it heard last night. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Thank you, Paul. Meta's platform revenue growth is recovering big time. In case you just missed it earlier, costs are under control, and Reels, those short-form videos like the ones you see on TikTok, well, they've drawn more attention to Instagram and Facebook, and it's helping pull in advertisers, too. If you missed him moments ago, Bloomberg Intelligence Mandeep Singh spoke with Bloomberg Surveillance earlier.
Cost control is the primary driver of why the stock has run up so much, because the margins are trending in the right direction. But with inflation pulling back, it's good for ad spending. And that's what we saw that, from Alphabet. I think Meta was no exception.
Just to give you an idea of how much the stock has been affected, nearly 18 months ago, Meta set a record for the biggest market value wipeout in stock market history. Different story today, though, with shares up more than 5.5%. You might be going up if you're an AT&T customer. Bloomberg's Kimberly Adams has the story on the bill increase.
The company is raising the cost of its unlimited elite wireless mobile plan next month by another $2.50 a month. It's the second rate hike in 2 years. That increase coming as subscriber growth slowed in the second quarter, more than Wall Street expected.
Thanks, Kimberly. Shares of AT&T down more than 1.5%. And Tesla owners aren't as impressed with Elon Musk, but they sure love those Model 3s. That's according to a Bloomberg survey of thousands of owners who together have put 100 million miles on their EVs. Out of dozens of questions asked that were repeated from a 29 survey, the biggest change in opinion was the drop in Musk's approval. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, it is looking at this market here, we get S&P 500 up 0.6%. The real magic is over there on the NASDAQ, up 1.1%, and even more so, the NASDAQ 100 up 1.44% on the back of some good tech numbers, particularly out of our good friends at Meta. And we just heard from Susan Lee, the CFO at Meta. They're growing the top line, they're managing costs, and that's what the street likes. All right, right now, let's go to Denise Pellegrini and let's get world and national news and all that kind of good stuff.
Actually, Paul, it's Nancy. I'm back. July is on pace to become the hottest month on record. That's according to new data from the Earth Observation Unit of the European Union Space Program and the World Meteorological Association. The heat has prompted the largest power grid in the U.S. to declare an emergency alert for today. And President Biden says the #1 weather-related killer is heat. He says you can see the effects of climate change now everywhere.
Droughts and hurricanes that are growing more frequent and intense. Wildfires spreading a smoky haze for thousands of miles, worsening air quality. The record temperatures, and I mean record, are now affecting more than 100 million Americans.
Biden says he's directing the Labor Department to increase inspections of potentially dangerous workplaces like farms and construction sites. And he says the infrastructure bill calls for $152 million to go toward drinking water infrastructure and climate resilience. Well, the grand jury overseeing evidence about former President Trump's efforts to overturn the 2020 election is meeting today in Washington. And Trump's attorneys met today with special counsel Jack Smith's team for about an hour. Insiders say lawyers have been told by prosecutors to expect an indictment against the former president. Israeli Prime Minister Benjamin Netanyahu is defending passage this week of a new law that would limit the power of his country's Supreme Court. The issue has been a flashpoint with protesters taking to the streets in opposition. Netanyahu says he purposefully moved slowly on the measure.
I did take seriously the concerns. I don't think the arguments are real, but I think the concern is real because people are afraid. I understand that. So I pressed the pause button for 3 months, try to get some kind of compromise on anything, and couldn't get anything from the opposition.
Netanyahu spoke with ABC News. His critics say the government is moving away from democracy. He calls that silly. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul.
Nancy, thank you so much. I made a mistake there earlier, but thank you very much, Nancy. Appreciate that. Thank you very much. All right, sound on. Joe Matthew, that is coming up in just moments. Joe Matthew, who's here in our Bloomberg Interactive Broker studio. Joe, I don't know how you guys program your show on most days. Today's one of those days. What are you guys thinking about today?
Well, it's kind of an exercise in what can we plan for and what do we need to leave open for the tree that will fall on us while we're on the air. And that might even be the case today. Everybody's talking about this indictment dropping today, you guys. Are you taking odds on this? Is there like an office pool in New
Fridays. Looks like Fridays is a good day for indictment. You run the media schedule all weekend.
And then so the Friday late news dump all weekend, Sunday shows. We come back Monday and find out what's the latest on Truth Social. I don't know. It could be tonight. Of course, he thought it was going to be last week. Right. He hasn't been terribly good at predicting his own legal timelines as we've experienced.
But it's something that we have the grand jury meeting today and all kinds of things could happen.
So this really could this could emerge. Meanwhile, we're trying to figure out how to fund the government and avoid a government shutdown, and everybody wants to go home for August recess. You guys are in the Hamptons this weekend, right? Because you're going to see all kinds of lawmakers flying in. They maybe they did or did not finish their work. It looks like the Senate will. Okay. They actually got 12 appropriations bills, like the old-fashioned, like Schoolhouse Rock. They actually did it, or they will by the end of the night, it appears. The House, not so much. The Chaos Caucus cannot agree even on an agriculture funding bill, which is supposed to be the easy part, over an argument that has to do with mail-order abortion pills or something. So everyone's going to make it home. Just some may have more to show for it than others.
Unreal.
All right, Joe, we'll be tuning into that in just moments. That's Sound On with Joe Matthew. Looking at these markets here, again, a good day in the markets. We had the ECB this morning, kind of reiterating what we heard from the Fed yesterday. If they're not there, they're pretty darn close to raising rates. And then, of course, we've got some pretty solid earnings coming out of Silicon Valley, led by our good friends at Meta. All right, folks, Sound On with Joe Matthew. Guess what? That starts right now.
4,600. You can see the U.S. 10-year yield rising now 8 basis points as investors sell off this debt, 394.63. So the 10-year getting ever closer once again to the 4% level just a few weeks after we came down from that. The Bloomberg U.S. Dollar Index is also on a tear. You know, it had come down to 1,200 even with 5 days of drops in a row, and since then has just been bouncing back up. The euro is below 110, the pound is below 130. And then maybe most interestingly, you see NYMEX crude now solidly above $80 a barrel. This is West Texas Intermediate, not Brent, up $1.78 to $80.56. So a lot going on in terms of asset prices. And then if you want to dig deeper into what's driving the stock market higher, certainly the S&P getting a huge boost from Meta after earnings. The owner of Facebook rallying after posting strong results for the second quarter, also giving an optimistic outlook, saying that more than 3 billion people use at least one of its products every single day. Absolutely gigantic scale. And if they can do that while also sucking in the ad dollars, they can just continue to print money. We've got an expert on that for you right now. Mark Douglas is the CEO of advertising software firm Mountain. He joins us right now. Mark, great to have you on the program after these Meta results. I got a note from you pointing out that there are two different kinds of ad sellers, right? One group sells ads, the other one sells really an outcome. And that's what you said about Google, about Mountain, and about Facebook. Explain what you mean.
Yeah, so essentially you have in the ad market, you think of big television advertisers, they're trying to build awareness. And so when people often think of advertising, they think of these big brands that spend literally hundreds of millions of dollars on TV advertising. And really you're talking about just a couple thousand advertisers. But in the space that we call outcome-based advertising, and that's direct response, it's paid search, it's paid social, it's performance TV, you're talking, hundreds of thousands to millions of businesses that are advertising to get consumers to see their brand, come to their website, or come to their app, and potentially purchase. And that's the market that Meta is in. So they are virtually immune from economic downturns. In fact, when things go bad, their revenue tends to go up because those advertisers want to invest more to get that consumer traffic.
One of the things I noticed in going through the analysts' reactions, Mark, to the earnings is a lot of them are saying Meta is going to be able to really leverage artificial intelligence, to leverage AI for other businesses, for small to mid-sized businesses. How is that going to work?
Yeah, so the really hard part is when you have a larger brand, they have brand equity. You might have heard of them, your friends might have heard of them, your coworkers might have heard of them. But when you get these smaller and smaller brands, not only do they have to figure out who would be interested in this company and this product, there's no brand equity. They really have to nail finding that consumer that's going to be interested in that product. And that is, without a doubt, as it relates to advertising, almost the holy grail of direct response advertising. And I think Meta's making big investments there. Mountain is making big. I think everybody in direct response advertising, that's the goal, is to really match that consumer with the right product that's going to be of interest to them. I think it is going to bear a lot of fruit.
Is it really, apparently more and more people are watching Reels, which are short videos, the kind that you would see on TikTok. Do you think they're really making headway into taking market share away from TikTok? Are the kids happy to watch Reels and put TikTok away?
I think they needed to do it for Instagram to make sure the app didn't lose relevancy. And so, I think a lot of TikTok users also use Instagram and vice versa. And, people want short form content on these apps. They want it to be interactive, funny, engaging, maybe, exciting. And so that is something they had to do. And I don't know that takes market share back away from TikTok, but it keeps them solidly in the game.
I also wonder about Threads. They famously added 100 million users in the first 5 or 6 days of Threads, but they haven't come up with basic features like a desktop app that super users like Joe Weisenthal need in order to make the product relevant. Why do you think they came out with the product that doesn't seem really finished?
Yeah, I mean, I think Reed Hastings said, if you're not embarrassed by your first product release, you waited too long to release it. So, and so in Silicon Valley, the mantra is release early and often. I think Threads is a solid up. The fact that it grew to hundreds of millions of accounts literally within days, and they were able to scale that. I mean, it's something that in some ways Twitter should be a little jealous of, because they had in Twitter Spaces, they couldn't handle certain meetings that recently politically related. And so it proved that Meta has incredible infrastructure. Getting the engagement, obviously that's going to be a lot harder. Just getting people to really every day go to this app and engage with it. And that's the cycle they are now, but they have Instagram to leverage in order to get that engagement. I think that's probably what they're focused on, is how do we get this Instagram community to now extend their daily behavior over to Threads, and so they can grow both of them together.
Mark, how much more engagement can they really hope for? I mean, they've already got 3 billion people, a third of the planet, using one of their apps at least once a day. It just seems unbelievable that you could grow any further from there.
Yeah, I mean, it's a lot of people, but they have to get Threads. You got to get people in there if that app's going to be successful long term. They have to get in there 15 minutes a day or start to weave Threads capabilities into Instagram, which if I were them, that's what I'd be looking to do, is just kind of like you're using, just like you were kind of a Threads user with one click, you start getting Threads posts into Instagram and vice versa. By the way, it would be a boom to them in terms of data. I think one of the biggest issues is back in the day when everyone was on Facebook, you really typed in what your thoughts were, and the data from that for targeting was incredible. And they need that again from Threads. If you type, hey, I'm thinking about going to I think the Maldives are incredible, guess what ads you might get in Instagram 5 minutes later, right? And so Threads holds this potential to be a more kind of word-based engaging platform that they can then target with and then advertise in Instagram or other apps with. So it's all one ecosystem.
Mark, I just want to ask a broader question, because you've got your finger on the pulse of Silicon Valley. How is the left coast dealing with these higher rates? The Fed just came out again yesterday and boosted us to 5.5%. After the collapse of SVB, which was already a problem for startups, how do these tech companies deal with rates they've never seen before?
Yeah, I mean, most tech companies are not borrowing money. What made SVB such an incredible partner was you would raise a round of funding, and then they would extend your rounds by loaning you more, additional money, so that you can have more of what everyone refers to as runway on that round of funding. The interest rate on that didn't matter, because no matter what it is, it was cheaper than going out and raising more money. So really, it's can you still get those kind of loans that extend funding rounds? And so I think everyone, it's sad that SVB in its previous state is gone. Obviously, it still exists in its new state. And, hopefully something's going to replace that. But I don't think the average tech company is very focused on interest rates as part of their business.
All right, Mark, great to get you on the program. Thanks so much for joining us. Mountain CEO Mark Douglas, who is our go-to guy, really, when it comes to advertising, especially on demand. Now, coming up, eBay's CEO joins us next as their latest results come out, their push into luxury sales, and thoughts as well on Elon Musk's X app. This is Bloomberg.
2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on a size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Markets. I'm Matt Miller. Taking a look at shares of eBay right now. They are off, having their worst trading day since February after the third quarter earnings outlook missed estimates. So they beat on the earnings report, but they missed what analysts were expecting in the guidance, with concerns that growth initiatives could result in reduced margins. Let's talk about this with the CEO of eBay. Jamie Iannone joins us now. So Jamie, let's talk first about that outlook. You know, analysts love to hear a good outlook, and I've learned in the last 20 years that it's probably better to underpromise and overdeliver. Is that what you're doing here?
Look, we're really pleased with the momentum that we're seeing. We beat across all the metrics, the expectations in the quarter, and the strategy that we've laid out is working. We've had this strategy of going after focus categories. Our focus categories grew 7 points faster than the rest of the market. When we look at the long-term opportunities for eBay, we feel really great about it. You know, the strategy that we have is really focused on 3 elements, which is, you know, in raising the bar and going after relevant experiences, building scalable solutions, and building magical innovations, really reinventing the future of e-commerce for enthusiasts, and it's working. We're increasing customer satisfaction on the platform, and our new innovations are being well received by customers.
So full disclosure in that I am like an eBay power user, and I have been for over a decade, maybe 2, but I'm 50 years old and I buy and sell motorcycle and car parts, right? That's so typical. You need to grow beyond me in order to please the street. How are you doing that?
Well, thank you for your business. Like other enthusiasts, our motors, parts, and accessories business for the second quarter in a row grew at market rates of growth at mid-single digits. New buyers in that category grew double digits faster than the rest of the platform, so it's working well. But you ask, how are we acquiring Gen Zs? Well, we're doing great work across the board in, for example, sneakers, and we're authenticating sneakers and bringing new sneakerheads in. This quarter, we just launched Authenticity Guarantee for streetwear, bringing in leading brands in streetwear. We're also very strong in a fashion standpoint, bringing in a younger consumer and a more female consumer. We just acquired a company called Certa Logo based out of Milan, which helps drive sustainability in fashion and drives pre-loved through some great AI technology. We're sponsoring Love Island over there. So we're doing a great job across the board, both catering to our parts and accessories enthusiasts like you, but also bringing in younger shoppers, female shoppers through what we're doing in sneakers, in jewelry. We've launched authentication in handbags on the platform, and that's performing extremely well. And frankly, refurbished. We've become really focused on the circular economy and pre-loved. And in times like this, people need values. And when you look at our refurbished category, it's growing double digits year over year because of the great values that we can provide in that business.
I want to ask you about Elon Musk's X app, just because the idea, and we've seen a great success in this kind of everything app in Asia. I don't understand why eBay doesn't want to do the same thing. It seems to me that you're perfectly positioned to be that. Have you thought about it?
Well, look, our third pillar of our strategy is about magical innovations. So we're doing a bunch of groundbreaking things. First, we're bringing live commerce to the rest of the world. We've had hundreds of live commerce events for our sellers, selling handbags, watches, trading cards, and they're having great feedback from those experiences. In addition, we're really having an explosion of innovation around AI at eBay. So we're launching a feature called Magical Listing. In Magical Listing, we do all of the hard work for you. You put your camera up to it. We identify what the picture, what the object is, the product you're selling. We write the description for you. We fill out all the specifics. We tell you how to price it. And people look at this and they say, wow, this is going to unlock so much more inventory in my closet and things around the house because you've made this so easy with this new AI technology that you've brought into eBay.
You have Amazon with a Prime membership that's done very well. Walmart now has a Walmart Plus membership, and they've overtaken eBay in online sales in the U.S. Are you thinking about some kind of membership or a higher tier, power user level?
You know what's great about eBay is we get that same level of customer lifetime spend without them having to pay an upfront membership fee. So if you look at our enthusiast buyers, they're actually 70% of the GMV on the platform. They're growing. They spend over $3,000 a year on the platform. And what's unique about eBay is the cross-category shopping nature. We'll acquire a buyer into sneakers, and they'll buy $400 of sneakers, but then they'll go on and shop and spend $2,000 outside of sneakers on other parts of the site. And that's really unique for eBay is we can provide these relevant experiences for your category, but also have these massive scalable solutions where we can bring, cross-border trade for 190 countries to a given seller. That's unique about eBay. That's why we have these enthusiast buyers. And our strategy to do more full funnel marketing to bring on more parts and enthusiast buyers like you has been working really well.
I'm a motors man, so I thank you for that. Jamie, thanks so much for joining us. eBay CEO Jamie Iannone talking about the business after the results. Coming up, President Biden just spoke about how extreme heat is costing the U.S. $100 billion a year. We'll look at how America is powering up to defeat this extreme weather, or at least keep cool. Federal Energy Regulatory Commission Chair Willie Phillips joins us next. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
This is
is Bloomberg Markets. I'm Matt Miller. I want to get something now that caught my eye. Extreme heat this summer is pushing air conditioner sales to lofty levels in the U.S., adding billions to companies already eyeing record profits. Carrier Group and Lennox are among AC makers boosting full-year guidance as sales easily top estimates. And investors are taking note. The HVAC index is up 20% from the start of June and nearing an all-time high. Now, sticking with energy, let's bring in Willie Phillips. He's the Federal Energy Regulatory Commission chairman. And Mr. Chairman, it's a great time to have you on. Thanks so much for joining us. Clearly, there is a concern as all these air conditioners get plugged in and turned up to max that we're going to have a problem with our grids across the country. Are you seeing weaknesses? Are you worried about failures?
Well, thank you. Thank you for having me. I can tell you this. We are definitely concerned. We know, I was just in Austin, Texas last week, and they're dealing with the impacts of the extreme heat there. But what we just did today, the Federal Energy Regulatory Commission, the agency that I chair, is a historic day. We had a bipartisan, unanimous vote to approve a new regulation that's going to help bring new energy projects onto the grid. It's going to speed up the timeline to connect those projects to the grid. It's going to improve our reliability, which includes extreme weather, our resilience, and also lower costs for all customers. This is a great day for all Americans.
So in short, red tape, government red tape had held up to some extent our attempt to transition to alternative energy sources. What you and the commission are trying to do is get rid of some of that red tape so that you can streamline projects and get them to the goal line quicker.
That's right. I mean, we know there are huge backlogs. We have over 2,000 gigawatts of energy projects that are waiting to be connected to the grid. We also know that the timeline, the backlog, it is 4 times as big as it was just 10 years ago. It's 40% bigger than it was 2 years ago. And so what we're doing, we're aiming to bring that timeline down. Projects that were built in 2022 waited 5 years on average to be connected. That means that projects just starting today wouldn't even begin construction until 2028. That's unacceptable. Technology moves fast. Government regulations have to keep up.
What can you learn from this heat wave that we're experiencing, Mr. Chairman, in terms of what the grid needs to be capable of to deal with a transition to battery electric vehicles?
Well, we don't have to look any further than what's happening right now. We know from extreme weather, and brutally cold winter storms, that when there is a shortage of electric supply, it can be costly, it can even be deadly. That's why we're focused on making sure that projects that are needed for reliability and resilience are coming on. Let me put it this way. Without interconnection, a project, an energy project, is like a train without a track. That's why the Federal Energy Regulatory Commission has taken action. We are taking bipartisan, historic action to bring more resources on the grid. That's good for all customers.
Do you see a shift, by the way, when we see a spike in energy prices and a spike in gasoline prices, which we're starting to see again across the country, a shift over to more use on the grid?
So we know that energy demand and electric demand is on the rise. This impacts all of the things that we do at the commission. And so, again, that's why my focus since I've taken over from the commission, day one, has been reliability. And a huge part of that is the commitment to making sure that we have the rules in place that can help power the electric grid that we need. To build a grid of the future, we have to make sure that we have long-term, holistic planning that takes account of the reality that's happening on the ground.
The grids that we have now are infamously old and brittle. If you had a congressional genie in a bottle, what would you wish for, Mr. Chairman, in order to completely modernize the U.S. electric grids?
Well, I mean, I think we're doing at the Federal Energy Regulatory Commission what we need to do is focusing on our mission. I made transmission reform a top priority when I became chairman. And so while this rule is a great first step, I think that, and I tell you, we are just getting started. We have more work to do. We have the long-term regional planning rule that has been proposed. We look to finalize that rule in the coming months. So that's what we're doing. FERC is working hard. FERC is working as it should work.
All right, Mr. Chairman, thank you so much for joining us. Really appreciate your time. Hope we can have you back. Willie Phillips there is chairman of the Federal Energy Regulatory Commission. I want to quickly break some news on the Bank of Japan. We've heard, of course, from the Fed and the ECB, and now the Bank of Japan is expected to discuss yield curve control, a tweak to its yield curve control in order to allow rates to float higher than 0.5%. This is being reported by the Japanese news agency Nikkei. So very interesting moves, reaction in the markets. We're seeing here that the U.S. dollar is weakening now, I should say, against the yen. You can buy now less than 140 yen for $1 US. We'll talk more about this when we come back. This is Bloomberg.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
This is Bloomberg.
Welcome to Bloomberg Markets. I'm Amber Kanwar.
And I'm Matt Miller. A lot of action in the markets today, so let's get straight to it. You have the S&P 500 gaining right now about 0.2%. We've taken a significant leg lower because a half hour ago we were gaining 0.7%, but we're still at 45.76, so decent gains on the S&P 500. You can see that the 10-year is now up 11 basis points in yield as investors sell off those bonds, so 397.42 is the level we're looking at there. The dollar index continues to rise. The Bloomberg dollar index right now at 12.15. Not the strength we saw earlier, but a big bounce from the 1,200 level of last week. And the euro, as we know, is down below 110. The pound down below 130. And then finally, NYMEX crude, really the big mover of the day, gaining $1.34 to solidly more than $80, $80.12 for West Texas Intermediate. Amber, what are you watching?
Well, let's take a look at some of the big moves that we're seeing under the hood of the S&P 500. Meta, of course, coming out with a beat and raise quarter and showing some discipline on the expense side of things. Align, meanwhile, I mean, kids today, they have it so easy. They don't have the clear braces, the multicolor elastics. They just get this beautiful Invisalign braces to help straighten out their teeth. Well, that's benefiting the bottom line at Align Technologies, which makes those. On the flip side, though, we do have some weakness. These stocks rose on hope, and results in their latest earnings were a little bit of a reality check. Both Southwest and Chipotle offering a forecast that was a little bit disappointing, Matt.
A little bit disappointing, and as a result, the markets are punishing them significantly. It's interesting to see them move so low, but actually the group there on the S&P is doing quite well. Let's talk about FX, though. The U.S. dollar is weakening against the yen. The Bank of Japan is talking about tweaking its yield curve control policy. That's according to Japanese news agency Nikkei. Let's discuss with Callie Cox, eToro investment analyst. Callie, it's interesting because we've been waiting for this it's been at least a year that we've been waiting for this kind of announcement. We finally get it, and it moves the markets a little bit. What's your take?
Well, like you said, Matt, I think we've all been waiting for this. It's not much of a surprise. I mean, Japan has had one of the best performing stock markets this year. It's had one of the strongest economic rebounds. So some loosening up on the yield curve control was to be expected. And I think you're seeing that in the market's reaction.
I think a much bigger surprise, Callie, was the GDP numbers as well as inflation that we got out of the U.S. this morning, right? A much stronger GDP reading than had been anticipated for the second quarter, and a little bit better core PCE numbers than we were looking for, 3.8% instead of 4%. What's your take on the U.S. economy?
Yeah, so to your point, I think that's what U.S. investors are putting a little more stock in today. And, this GDP print, along with many other GDP prints we've seen in the past few quarters, are really hard to argue with. I mean, we've got strong consumer spending, strong final demand. We have inflation that's clearly coming down. And I think that, coupled with what we heard from Jay Powell yesterday, really takes out this chance of a recession that everybody's been worrying about. I think the chance is still there, but Powell and the Fed seem to be willing to step in if we see any job market weakness because of the progress we've seen in inflation. So we've been more optimistic than the usual Wall Street firm, telling clients to be a little more cautious around these levels. But we felt very encouraged by the economic data we've seen recently and the Fed's willingness to be flexible.
I wonder if Powell did get a look at those numbers because, as you mentioned in the press conference yesterday, kind of took the chance of a recession off the table. You saw the market kind of respond to that by pricing in a lower risk of a September rate hike. But the question is, does GDP this strong, is that at odds with getting back to inflation target?
I think it could be. And, from the data we've seen so far, it looks like services inflation, which is the demand side inflation that the Fed is trying to control, services inflation is coming down a bit. And Powell actually shrugged off the fact that wages were feeding as much into inflation, which I think is a worry among economists on Wall Street. I mean, wage growth is great. We all love a pay raise, but wages are also the biggest cost for businesses. So that pay raise you're getting could lead into higher inflation. So I think that's still an open question, Amber. December. Again, we're feeling quite optimistic, especially considering what we've seen from inflation data lately. But if there were a risk to pop up, I'd say that be it, the reignition of inflation.
And it's all filtering into the equity markets where it's all systems go. We've got growth, we've got subdued inflation, we have earnings that are beating expectations, we have a broadening out of the rally. Is there anything that is giving you pause and caution to investors putting additional dollars to work today?
Well, we're looking at a pretty great picture. You summed it up really well. I think sentiment is giving a few of us pause, especially us on eToro's side of the pond. Thinking about the fact that we're happy that people are feeling more optimistic, but we don't want them to pile too far into speculation, especially when interest rates are so high. And high rates are still a concern, too. They're becoming less and less of a concern, especially given that inflation has come down so far. But in a high rate environment, it can be really tough to look at small speculative companies that, can't self-fund and aren't profitable. So that's what we're reminding customers. Of course, we look toward the retail investor who's more willing to speculate in, more risky names here and there. And we're telling people it's still time to look for quality risk. You can be happy here, but make sure you're looking at companies that you think can weather a recession, because that risk isn't completely off the table.
If you're talking to retail investors, Callie, don't you just tell them to track an index and be done with it? I mean, stock picking is very unlikely to work for retail investors.
Well, look, I'm not somebody to ever tell somebody else what to do with their money. And a lot of our customers are those long-term investors, but they have a play account on the side and they want to be a little more tactical with the money that they have. So I don't think it's a black and white type thing. Investors are doing this or that. I think many investors are long-term investors at heart, but they're learning to become more sophisticated and educated within the markets, and they are trying out some more complex strategies. And we're here to help them along the way.
It is tempting, though, when you see these returns to kind of shun what's going on in the bond market. How are you thinking about allocations to fixed income?
Well, I think this goes back to recession risks, Amber. I mean, we have been telling our customers that it may be time to pick up some conservative bond exposure here, considering the fact that, again, we're in a high rate environment. Growth is clearly slowing down. The Fed is being more flexible, which is great news for stocks. But that recession risk, while lower, isn't completely off the table. So with rates at 4% and Treasury's track record in past recessions, we think it's important to, maybe pick up some bonds as a sanity hedge.
All right. Thank you so much to eToro investment analyst Callie Cox for joining us this afternoon. Coming up next, MasterCard sees a jump on travel and entertainment spending. More on the latest quarter from MasterCard. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make. I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This is Bloomberg Markets. I'm Amber Canmore with Matt Miller. It is time now for Stock of the Hour. MasterCard credit card volume rose more than expected, with many consumers spending on international travel, which is boosting revenue as well in the quarter, I should say, by 14%. Bloomberg's Jenny Serrain reported on this and joins us now. Jenny, thanks so much for being with us. Put these numbers into context, especially with the pandemic and the huge boost that they saw. Where are we with respect to, back to normal operations?
Yeah, I mean, I think what's really strange is that everyone really expected this quarter to be one of a major slowdown, and we really haven't seen that yet. Consumers are still going out, they're traveling, they're spending on entertainment, and that's really why you've seen MasterCard kind of blow expectations out of the water here, and it's just really kind of flying in the face of what folks were expecting, given how interest rates have been rising so aggressively and just the kind of continued fears of a recession. You really don't see that in MasterCard's numbers today.
Purchase volume on the firm's card jumped 13.5% to $1.84 trillion. So people are definitely spending money on plastic. Is there anything holding them back? I mean, are they paying off their bills monthly? Have they stopped using cash? Is that part of the story?
That's definitely part of the story. So especially for smaller transactions, pre-pandemic, you would see a lot of cash usage there. And now that we've got tap to pay pretty widely available in the US, that's really been another boon for MasterCard. But no, I mean, I think, I talked to CFO Sachin Mehra, and he was even saying, we look, even within our numbers to see how do premium consumers maybe compare to mass affluent consumers. Like, are the richer folks papering over maybe some stumblings by lower income consumers? They're not even seeing that. This is really broad-based gains and really just a sign that consumer confidence is at the highs that we've been talking about.
And yet the stock is pulling back. Was there a blemish in the quarter, or is this just an example of, a stock that's run up and you use earnings as an excuse to sell?
No, I think, one thing that came out today was that they just reaffirmed their guidance for the year. And given that this quarter was, such a huge beat, I think folks are wondering, why didn't that allow you to kind of give you more movement on the full year guidance? And, they actually got asked about that during their call today. And really they just said, guidance is a range and we feel really good about where we're at right now. But I think that's part of it. Also, the indexes that they're in, they're now in the financials index, which is also getting a little bit of pressure today, given all the stuff we've been writing about with the Fed and the FDIC and their big changes to capital rules that they've proposed. So they might also be kind of getting caught up in some of that as well.
Jenny, I'm sure this is a tiny, almost irrelevant portion of their business, but I would be remiss if I didn't bring up yesterday's story that MasterCard is demanding payment processors stop allowing weed purchases
is with their debit cards. What's that all about?
Yeah, so to your point, probably not really making a huge difference for their go-forward earnings, but really they've just been investigating this space for a long time. You know, what's really common in that area is folks go in and they use their debit card at an ATM and get cash, and it's just something that MasterCard wasn't a huge fan of as they kind of investigated further, and so they've asked that their processors kind of go to those merchants and let them know they're no longer allowed to be processing on the MasterCard network. And so it'll be interesting if we see that come up, but I think it was still probably a little bit too small of volumes to make a difference.
Not a big chunk of the $1.84 trillion.
Not quite yet.
No.
All right, thank you so much to Bloomberg's Jenny Serrain for that. Coming up next, U.S. bank regulators unveil plans for their most comprehensive overhaul of capital rules in years. Insights on what that means for the sector from Kevin Fromer, the CEO of Financial Services Forum. This is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Markets. I'm Matt Miller with Amber Kanwar. Now, it's the most comprehensive overhaul of bank capital rules in years. U.S. regulators unveiled a plan that would force the biggest banks in the U.S. to increase capital by 19%. Kevin Fromer joins us now, CEO of the Financial Services Forum, which advises, I guess, these banks, Kevin, are your members. So tell us the reaction.
Well, first of all, Matt, thanks for having me. I think I should start with repeating what you just said, because it's very important. Increasing capital requirements by at least 20% for the largest institutions. This is something that the Fed, the OCC, and the FDIC have voted on today, and it will significantly increase, we believe, costs that apply to services and lending that American families and businesses rely upon. That 20% increase, which could be understating the actual impact of the largest institutions, comes at a time when the industry has never been better capitalized, and that's been established by stress tests, real-life stress tests, as well as the Fed-run stress tests, multiple stress tests over the years. Capital levels have increased by a level of 3 since the crisis, since the global crisis and the recession. So there's no justification for large increases in capital for these institutions right now. And we think that policymakers are going to have to take a really hard look at this proposal to examine the costs I think we've seen the banking system perform very, very well over time.
They have, but haven't these banks, and if I'm not mistaken, I think you represent the 8 biggest banks, right? They've been huge recipients of deposit flows after the collapse of SVB and others. So they have done very well, as we've seen in the most recent earnings reports.
They've done very well because they're strong institutions. They're institutions that have built up their capital and overall resiliency over the years. A lot of this is a result of Dodd-Frank era regulation and the work of international regulators focused on capital standards. So they're very healthy institutions. That's why they do draw deposits. We're at a situation now, however, where increasing capital at the level that is anticipated from this proposal is really sort of a solution without a problem. No one has established why you would need to raise capital levels for these institutions to this extent. And other jurisdictions who have internationally active banks who are also going to be implementing these same standards are not going to adopt this approach. They are going to ensure that the Basel standards are met, but not in a way that significantly raises capital requirements. So again, the U.S. as a policy has decided to be super equivalent with respect to these international standards, and it looks as if we're going to go beyond the capital required to meet the standards. We're going to be above and beyond where our peers are in the European Union in particular, and there's no reason for that right now.
Well, this is not just happening in a vacuum. This is happening after we got the first, banking collapse that we'd seen since the financial crisis. And while your argument is that ultimately this is going to raise the cost for Main Street, I guess part of the purpose is to make sure that if there is yet another stumbling block, whether with respect to these companies' balance sheets or the economy, that Main Street is not on the hook for it.
Well, large institutions and their capital adequacy and the Basel standard itself has nothing to do with the situation in March involving Silicon Valley Bank or Signature Bank. And in fact, you saw these very institutions put deposits in First Republic Bank, frankly, to buy time for the regulators to deal with that institution. So there's no question about the capital adequacy of the 8 largest institutions. And the banking system as a whole, I think, is well capitalized as well.
You mentioned that this might hurt competitiveness. There are hundreds, thousands of banks out there. How does this hurt competitiveness?
Well, again, we have standards that have been agreed by the Basel Committee. And as they've been implemented in the various jurisdictions, the United States has decided to gold plate those standards. So we have higher capital requirements that are mandatory on the institutions. They're higher than the ones that exist outside the United States, particularly in the EU. The proposal that we see today is going to expand that differential. It's going to expand the disparity between very, very large U.S. institutions and their peers on the other side of the pond, same activities, same types of risks, but different capital requirements.
What are the chances?
And that's a competitiveness issue.
What are the chances, Kevin, that the big banks are going to be able to avoid this capital increase? How do you think the likelihood? How high do you think the likelihood is that they can win this fight?
Well, I think you have to look at the practical implications of these changes, and we've already seen reports and analysis coming from affected parties in the United States. Those that are focused on housing finance, community reinvestment, American businesses that rely on banks to help hedge and manage their business activities here and abroad. Those constituencies have already identified this proposal as costing, themselves as end users, essentially higher prices for the very things that they rely upon the banks for. So I think as we unpack this proposal, it's a 1,000-page proposal. Our industry is going to look at this hard. Based on what we know, I think we will be objecting to many parts of this. And I would also note, for you and your viewers, in past years, post-crisis, There was generally a consensus view that we needed to beef up capital requirements. Reserve Board and at the FDIC, we had dissension. We have comments that say we don't think that this is the right way to go. We've got lots of questions. So we had consensus in past years. We don't have consensus right now that this is necessary.
Do you think that the SEC specifically is overreaching in a lot of these regulatory cases? We have seen them lose cases when it comes to crypto. They put out a 83-page first salvo when it comes to regulating AI on Wall Street. Is this a Gary Gensler problem?
Well, the capital rules that we're talking about involve the Federal Reserve, the FDIC, and the OCC. I think you're referring to an SEC proposal that deals with artificial intelligence. And, our institutions, the largest institutions in particular, have an excellent track record of understanding and identifying the risks associated with innovation and technology, mitigating those risks, or not conducting those activities if they're deemed to be too high risk. And of course, they're highly supervised along the way.
I just see, and you can throw the FTC in there in terms of flexing regulatory muscle, that Wall Street is doing a lot of this. And I think we'll probably have to have you on again, Kevin, to address some of the broader issues, because compliance costs certainly are going to be a big part of it as well as capital. Kevin Fromer there is the CEO of the Financial Services Forum, a lobbying group that represents the 8 largest banks. Amber, it's been interesting. The markets continue to rally, and we'll continue to watch them with Romaine Bostick up next. For Amber Kanwar, I'm Matt Miller. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Resilient economic data giving buoyancy to a persistently bullish market. Live from Studio 2 at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. with about 2 hours to go. You're looking at an S&P 500 that is green by only about 0.1% or so. The NASDAQ 100, big tech, really carrying the rally here. You can see that again in the NASDAQ 100, up about 0.8% or so. You take a look, though, at what we're seeing in the yen. This is really interesting news breaking in the past hour that the Bank of Japan considering a tweak to its yield curve control policy, discussing letting that rise above the 0.5% cap. We'll see if that materializes, but in the meantime, you're seeing dollar weakness against the yen. As a result, dollar-yen dipping here. And I did want to check in with crude because actually, Romaine, we got above $80 a barrel today. We're slightly below that right now, but pretty close. Crude up about 1%.
Yeah, that rally in oil, combine that with the rally in stocks. Most of the market moves today linked to the economic data from this morning. A U.S. GDP report that showed economic growth unexpectedly picking up steam in the second quarter. And then you had a key gauge of inflation decelerating further, positives. You combine that with other data out on Thursday that tended to show stronger than expected business equipment orders and fewer applications for unemployment benefits. And look, you can make a compelling case right now that the case for recession, I don't know, maybe it's been a bit premature. But that economic resilience is causing some concerns here about complacency. Dan Iveson, co-manager of the $124 billion PIMCO Income Fund, says investors should mind the gap. The risk of rate hikes, in his view, likely to linger for some time. He points to the housing market, and more importantly, this chart behind me, elevated property prices that, in his view, will continue to feed into higher rents, which will continue to feed into higher inflation, which in turn could feed into an economic downturn. And that's putting even more attention on corporate earnings. Katie, coming into this season, investors were really focused on two things: the Fed stopping those rate hikes, and more importantly, the economy avoiding recession. How are we looking so far?
So far on the recession front, seems like we're doing okay if you look at the data from this morning. On the earnings front, doing pretty well so far. It's still early, of course. We're in the thick of the busiest season. And of course, there's been a lot of focus on individual companies, including Mattel. Of course, after that box office weekend that we had with the Barbie release, finally, it's interesting. If you take a look at story counts right now, by this metric, Barbie is currently bigger than Bitcoin. You can see that that story count mentioned really skyrocketed in the past month, in the month of July, overtaking Bitcoin. And how that's translating into Mattel's earnings, though, is a different story. We haven't yet seen a bump to Barbie sales. You have seen a bump to the stock, though. If you take a look at the one-year stock of Mattel, it's down still 6% over the past year, but you focus just on 2023, up over 20% so far this year. You focus just in the past month, you can see we've really climbed higher. Again, no material bump from the Barbie movie, Romaine, but that could be on the way.
It could potentially be on the way. Mattel shares up for a second day on the back of those earnings here. We should point out a 30+% gain over just the past three and a half months alone. A lot of that really being fueled by the CEO's strategy of licensing out a lot of that IP. Of course, Barbie and that movie, sort of the kickoff of really wedging Mattel back into the cultural zeitgeist. Pleased to say that the man behind that push is joining us right now. Ynon Kreiz is the CEO of Mattel, and he joins us now, fresh off the heels of an earnings report that we knew Ynon wasn't going to include some of the potential uplift from Barbie, given that that movie was just released to the public a week ago. But what are your expectations going forward as to how the success of that film for Warner Brothers is going to translate into success in selling toys and other products for Mattel?
Yes, Romaine, from the beginning, this was never just about making a movie. The goal was to create a cultural event, a societal moment. And we could not be more proud and excited by the success of the movie at the just barely a week since the release. Phenomenal success at the box office. And of course, what we're seeing is that a very broad audience is going to the cinema beyond the core Barbie fans. We're seeing men, we're seeing people going multiple times, and we're seeing very strong performance in the international market. And this is before Japan even released, which is only going to happen in August. So very strong momentum for the brand. And we're very excited to see the overall market reaction.
Do you have any sort of sense, though, of sort of what sort of accretion to revenue the success of that movie will have for toys? And I bring that up too, Ynon, because there's been a lot of talk about the idea that this movie, it's a great movie, but it is certainly geared much more towards adults than it is the children that I would think would be the primary buyers of a lot of your products.
Well, we've seen the product related to the movie selling out very fast. We also expect to see impact on the Barbie brand overall. And since the movie launch, or I would say from the beginning of the third quarter, we're seeing significant improvement in POS in Barbie, and we expect that to continue to translate to strong performance overall for the brand. But this is not just about the quarter, and it's not just about the year. This is about long-term franchise management, and there's no debate that the halo effect of the movie and the way it will recontextualize what people think of Barbie and the emotional connection between Barbie fans and the franchise will elevate it and will be an important driver for growth in Barbie and the brand overall for years to come.
And point taken that this is about the franchise and this is about sort of a long-term plan here. But if we were to focus on what this could translate into for this year, there's some interesting estimates out from Stifel, for example, who thinks that the Barbie movie could generate about $100 million in revenue for Mattel. What do your own projections look like?
Well, we do have meaningful economic participation from the movie, directly in the movie. We have, of course, a lot of upside in movie-related product. We have more than 165 consumer product partners and retail collaborations all over the world tied directly to the movie. And of course, we continue to see growth and momentum in the Barbie brand overall. We haven't broken it out for the year, but this is, of course, a real driver economically. But, you know, taking a step back, I think it's important to emphasize that this is really a showcase for the cultural resonance of our intellectual property, our ability to attract and collaborate with top creative talent, and bringing our capabilities in franchise management and demand creation to the fore in very close collaboration with Warner Brothers that have done a tremendous job in marketing the movie.
Well, let's talk about what further collaborations could come, because again, if we look at the Mattel studio, or rather the portfolio, you have brands like Hot Wheels, you have American Girl, Barney, for example. When could we see the next Mattel-related movie?
Yes, we have a very exciting slate of more projects in development. We have Hot Wheels in partnership with J.J. Abrams as producer, with Warner Brothers, Matchbox with Skydance that produce Mission Impossible and Top Gun, Rock'em Sock'em Robots with Vin Diesel, Polly Pocket with Lily Collins, Major Matt Mason with Tom Hanks. Yeah. You mentioned Barney. So there's an exciting slate of projects. We haven't announced a release schedule, but all of these projects are progressing and are very exciting for us.
So you have to then have an eye on, I guess, the supply that you're going to need, assuming that this stays in the cultural zeitgeist. People are going to want to buy Barbies, maybe Hot Wheels, Barney, and some of the other products out there here. How have you prepared your company and your, I guess, your supply chain executives for dealing with any potential upswell in demand for these products?
Well, we transformed the company over the last 5 years to be a high-performing platform. We have an incredible design and development capability. Our supply chain is a competitive advantage in terms of scale, the breadth of our production capacity, and in ability to produce product at scale at a very productive and good cost structure for Mattel. And of course, a global commercial operation where we sell product in over 500,000 stores globally. So between design and development, supply chain and commercial, we have a very strong platform to grow our toy business.
Is that supply chain system right now for Mattel, is that diversified enough to avoid maybe some of the potential disruptions that we've seen other companies have had that have maybe been too dependent on China or other nations to produce the goods?
Yes, much of the work that we have done over the last few years was to create a modular supply chain system that can respond and react and be well diversified and flexible enough to cater for changes and be able to produce and manufacture product at the right time, at the right cost structure for the company, and take into consideration geopolitical implications.
All right, Ynon, well, this is certainly an exciting time for you. I know this is probably the most excitement people have had for a movie in quite some time. I assume you saw the Barbie movie and enjoyed it.
I saw it multiple times. Okay. It actually gets better every time I see it.
All right.
It's a great project.
A great endorsement there. Ynon, great to catch up with you. Ynon Kreiz, he's the CEO over at Mattel. Coming up here from one CEO to another, a conversation with Bill McDermott over at ServiceNow as it bets that AI will boost demand for its products. The big question is whether investors, Katie, are going to be buying it.
Plus, Piper Sandler says that Walmart shares could surge more than 30% in the next 12 months. We'll talk with the analyst behind that call.
And new capital rules out here potentially for U.S. bank regulators finally unveiling those plans, the most comprehensive overhaul of those rules in years, a full breakdown of what banks have in front of them. All that and more coming up next. This is Bloomberg.
Connection lost.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Earnings last night out of ServiceNow, the business software company, reporting a pretty decent jump in revenue, including subscription revenue in the quarter, coming in at about $2 billion and guiding on a full-year basis that'll bump up to as much as $8.6 billion on the subscription side. Nevertheless, investors still may be potentially looking for a little bit more. Bill McDermott, he is the chairman and CEO of ServiceNow. He joins us right now to talk about, I guess, Bill, whether you can give them a little bit more. 20+% growth, but investors are saying, I don't know, is that enough?
Well, we've been giving them a lot, and we're so proud of our company. You know, Romaine, this was another beat and raise quarter for the company in revenue, subscription revenue, operating margin. But I think the big story really is our innovation flywheel. We're the first mover to build AI into an enterprise platform like ServiceNow. and our AI business could not possibly be stronger. We have something called a pro version of our platform that's growing well over 50% on a year-over-year basis, and we just announced a ServiceNow AI Lighthouse customer program, which we're co-developing with NVIDIA and Accenture. My great friend Jensen and I spent a lot of time thinking about this, and we really believe that this is the moment where we can transform entire industries with generative AI on the ServiceNow platform. So we're extremely bullish on ServiceNow, as everyone else should be as well.
Have you had any meaningful discussions about how you price this and I guess what the uptake will be amongst your clients?
Well, the main thing to think about is if you're facing an insurance company, for example, and they're trying to reinvent their underwriting policy, or you're dealing with a healthcare institution that wants to provide better support for the patients and the clinicians, or you're dealing with a manufacturing company who wants to reinvent the factory floor or automate the supply chain and the onboarding process of the supply chain. These are large changes and transformations. So yes, there will be a Pro Plus version of our platform. We are announcing the next release on September 20th. We already have 125 of the world's most premier brands lined up to team up with ServiceNow and our partners on this. So we will have an uplift in the pricing because the business cases and the value extraction for our customers is absolutely sensational. And that is the ultimate win-win, when the customer gets everything they bargained for plus, and we on our innovation level get something in return, and shareholders, customers, and of course, our employees all win.
And Bill, one of the topics of conversation this earnings season where we've heard a lot about artificial intelligence is when that starts translating through to the bottom line. So some of these partnerships that you're making specific to AI, when do you expect that to start adding to your revenue growth?
That's the right question, Katie. And the good news about ServiceNow, and maybe it touches a little bit on Romaine's question as well, is can you give us more in the guide? And the reality is the guide is very strong, but we did not plan for these big transformational undertakings to significantly impact our revenue in 2023. We actually think a lot of that will go into 2024 because some of the budgeting cycles for IT budgets at an enterprise level are decided on each year. And clearly, in the new year, I expect CEOs and the C-suite to disproportionately fund generative AI initiatives where they're working with enterprise platforms like ServiceNow on their own data. And that is the power of ServiceNow. We are working with the customer's data. We are also working as the control tower for enterprise digital transformation as we also integrate to Microsoft Azure and OpenAI itself if the customer chooses to bring that data into the equation. So I think you're going to see a huge tailwind for ServiceNow in 2024, and we might even be able to get some of that sooner depending on how the customers behave between September and December. But we're super excited. I left the bull case out there, and we're going to work really hard to achieve not just a very robust guide, but also something extra with transformational AI.
And Bill, I'm sad to say we only have about 45 seconds left with you, but as you're thinking ambitiously about the future, are you considering any M&A to help fuel that?
You know, that's the beauty of our business, Katie. We have an organic innovation flywheel here that is absolutely unstoppable, and the platform literally can do anything. So if we were to do something, it would likely be of a tuck-in nature because it would be more human capital oriented or research oriented or data science oriented than it would be buying a company with revenue, because we've got plenty of ideas, plenty of innovation, and lots of growth right here at ServiceNow. So the organic strategy is paying off.
All right, Bill, going to have to leave it there. Always appreciate you taking time for us. Bill McDermott is the chairman and CEO of ServiceNow. Stick with us. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
All right, to pick up in economic growth here in the U.S., maybe underpinning, I guess, some of those calls that all those worst-case scenarios with regards to recession may have been overdone. The Fed, at least for right now, seems content with where rates are. No real signal yet as to whether rates will go higher. But the ECB also signaling, too, that it is in the same boat. A 9th straight increase over there in Europe, and now a big focus on data and data dependency. Data that, at least right now in the U.S., in Europe, and in other parts of the world, does show a level of resiliency that could raise concerns here about a resurgence in inflation down the road. Subhadra Rajapal joining us, head of U.S. rate strategy over at Societe Generale. And let's start off here with, I guess, what is data dependency in this environment? Because the data seems, I don't know, maybe not clear, but it's certainly not as ambiguous as it was maybe a few months ago.
Yeah, the data has been relatively strong in the U.S., especially relative to the other countries. And data dependency means they're going to look at data coming in between now and September to decide if they're going to have to move again in September. But broadly speaking, it's only sort of an incremental increase in policy rates from here on, given the fact that they've already delivered, 5.5 percentage points of increase in policy rates. So we've moved dramatically higher. There is perhaps a little bit more room for the Fed to move policy higher. But for the most part, I think a bulk of the work is already done. So it's just more a question of waiting to see how the data progresses from here on.
But then does this sort of create that more positive scenario for the Fed and for central bankers worldwide, that idea of a soft landing, Subhadra? Because I was told that, 5 percentage points of rate hikes would break this economy. And here we are today sitting on annual growth of 2.5%, close to 2.5%.
Yeah, I mean, we're in a very unique situation
Connection
from a
lost.
Fundamental perspective. We've never seen an environment where we've had this level of both monetary and fiscal stimulus in a very short amount of time. We're also in an economic environment where the economy is not as sensitive as it's been in the past to higher interest rates. So in some respects, the Fed has to keep policy high for a much longer period of time to see what the impact will be of higher policy on the broader economy. And that transmission mechanism is clearly taking a lot longer, which is why I think we're calling for, sort of a soft landing environment. But a recession this year does not look like it's imminent.
Subhadra, I was so excited to see your name on the rundown today because it was really interesting listening to Powell yesterday, and he kind of entered into a hypothetical scenario. He said that imagine it's a world where things are okay, it's time to bring rates down from restrictive levels. Normalization in the case of the balance sheet would be to reduce quantitative tightening. So maybe a world where you're seeing the Fed cut rates but still continuing to wind down the balance sheet. That's how I read it. If that's how you read it, what kind of communication challenge would that pose for the Fed?
So historically, the Fed has not tried to cut rates and wind down the balance sheet, and continue to do quantitative tightening at the same time. So In some respects, those two policy measures are the opposite. We'll have to see what they do. We also don't know what the appropriate level of reserves will be next year this time. So we think over the near term, for the remainder of the year, they're going to be able to continue to wind down their balance sheet. But come next year, if they do have to cut rates, it's not clear to me that they will continue to wind down their balance sheet as they're cutting rates. So we'll have to see how that plays out. But it looks like Chair Powell is open to the idea of some level of normalizing the balance sheet while they keep rates on hold, as well as perhaps even when they cut rates.
All right, Subhadra, always wonderful to talk to you. Subhadra Rajapal, Societe Generale's head of U.S. rate strategy, here on a Thursday afternoon, where the market reaction to that economic data this morning was decidedly positive. But as we get closer to these closing bells right now, Katie, it is turning decidedly negative. All of the major indices right now starting to dip into the red. The NASDAQ, really the only major one in the U.S. that's still in the green, up about 0.2%. And just a few seconds ago, the U.S. 10-year Treasury yield ticked back above 4%, up 13.5 basis points on this day alone.
Yeah, so we're back above 4% on the 10-year. You take a look at the 2-year yield, we're at 4.9293 if you want to round up. So getting close to 5% there.
A VIX that had been tamped down at one point below 13, now back above 14 here. The risk on mood turning to risk off. This is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Bloomberg Markets to close a little bit before 2:30 here in New York. Time to get a check on what's going on in the commodity space. Commodities as a whole lower on the day with one big exception, and that's crude oil. Abigail Doolittle standing by with that.
It is crude oil, up 1.6% remain for WTI crude, having a lot to do with the GDP print that shows economic growth here in the U.S. and the idea that there will be demand for crude back above $80 a barrel for the first time, I believe, since April. But to Romaine, your point, most of the commodities today are lower. Overall, the Bloomberg Commodity Index down about 0.6%. Now, natural gas futures, it has to do with an inventory build that was unexpected. On the other hand, I was outside moments ago, and it's so hot here in New York, you would think natural gas would be higher. That's simply not the case. Silver down 2.6% on that higher dollar, and then corn futures down 1.1%, Romaine.
All right, Abigail Doolittle there with a look at what's going on in the commodity space. Let's take a look at what's going on with banks. Those shares all over the map after U.S. regulators unveiled plans to impose what is going to be the most comprehensive overhaul of bank capital rules in years. Bloomberg International Economics and Policy correspondent Michael McKee joining us right now from his perch in Washington. Looks like the headline here is basically a 19% boost to those capital requirements.
Well, at least, Romaine, for the biggest banks, what they have done is take the capital requirements and the testing responsibilities of the banks and added banks from $100 to $250 billion in assets to the list. That also includes the 8, what they call global systemically important banks, the GSIBs. And so at this point, it's going to be an expanded universe, and the smaller banks will have different levels of additional capital, but it works out to about 16%, 19% for the big banks. And then it imposes some new regulatory regimes for the various banks that will sort of combine the way the banks do their own evaluations with some standardized tests from the bank regulators, including the Fed, the FDIC, and the OCC. This is being put out to comment today. The FDIC, the OCC, and the Fed voted to put it out for public comment. They will take comments until November 30th, and then they will vote again to make a final rule. The Fed just finished voting. They adopted the Basel III proposal on a 4-2 vote. A couple of dissenters there. Jay Powell had some questions, but he voted yes. Michelle Bowman and Christopher Waller both voted no. They think the proposal adds too much regulation to the banks without gaining anything in terms of safety.
Let's talk about one of the big reasons why this matters, and of course that ties back to shareholder buybacks. The expectations is that this is going to really put a damper on that, Mike, for years to come, I believe is the estimate.
Well, you get a different story from the banks than you do from the regulators. The regulators' view is that most of the banks already have additional capital that they are not using that could be put to this purpose. And so they really don't need to raise a whole lot. Their other view is that these rules will be phased in over 3 years. So banks would be able to earn their way into additional capital, just set aside some of their earnings, and they would be able to keep paying dividends, and they would be able to keep doing buybacks. So a lot of this will be fought out in the comment section, and we'll see how the regulators come down when they get through that process.
All right, Michael McKee out there in Washington, and we should point out some other interesting angles coming out of this report here, including some of the mortgage requirements that could have some interesting ramifications going forward here, Katie, should this actually be enshrined into regulation.
Yeah, a lot of different stories out today. And on the regulation front specifically, of course, we had the SEC proposing restrictions for brokerages and money managers that use artificial intelligence to interact with their clients. And Bloomberg Television spoke with Chair Gary Gensler about that move earlier.
What we're trying to do is make sure that the technology aligns with that standard, that the technology that can predict about each and every one of us so much about how we might react to a little behavioral prompt or a little nudge, how we might react, that they're putting our interest as an investor in the right place and not putting themselves ahead of it.
And of course, that was SEC Chair Gary Gensler speaking with Bloomberg Television earlier today. And Romaine, this is part of a broader picture of regulators really being concerned about basically AI and how this technology is being used.
Absolutely, and I mean, but the other problem is too, you're trying to sort of put guardrails up around something that we don't quite really know what the structure of it's going to be, and I'm sure he's going to get a lot of pushback, if you will, or lobbying, as I think we call it these days.
Yeah, I would imagine that the industry none too pleased there, but I think that's a really important point. We're developing this in real time.
Yeah. Now, are these rules, are they coming before the crypto rules, or I'm just trying to keep up with the timeline here?
It would be interesting to see actually the breakdown of what the priority list looks like. Hopefully we'll hear about that.
He's been there, what, how long?
It's
almost,
been a while.
Almost 3 years now?
It's been a while.
Yeah, okay. Yeah. Just checking. All right, we should point out that the broader market is moving to the downside here as we get closer to the closing bells. Walmart, which had been higher on the day, now flipping into the red. But there are some folks out there that still see a bull case for the company. One analyst says that those shares could surge more than 30% over the next 12 months. We're going to talk to that analyst in just a bit. This is Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It is a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations, and we start off with Boeing. Bank of America upgrading the stock to buy on the notion that the worst for Boeing may actually be in the rearview mirror. The analyst says that demand and stronger deliveries will lead to midterm growth, but maintains some reservations about Boeing's ability to execute. That might be an understatement. Shares higher by 0.6%. Next, let's take a look at Meta, upgraded to overweight over at Wells Fargo. The price target going to $389. The analyst saying there are a lot of tailwinds out there for the company right now, and sees a bit of a call option on Meta shares when it comes to the promise of AI. Meta up 5% on the day. And finally, let's take a look at Coty. The beauty products maker downgraded over at Jefferies to hold. The analyst citing a slowdown in the company's premium fragrance business and also says that there could be a cycle shift to makeup from skincare that could actually add pressure on Coty's performance. Those shares down 6%, and those are some of our top calls. Let's stay in the sell side space right now and take a look at Walmart. Shares up about 11 to 12% on a year-to-date basis, but at least one analyst out there sees at least about 30% upside from current levels for the retailer. Edward Yerma joining us right now, managing director over at Piper Sandler. And earlier this week, he did upgrade the stock to overweight and boosted his price target to a street high, 210. All right, Ed, let's just start off here. When we talk about the potential upside here for this stock, is that coming from what? Revenue growth? Is it coming from margin expansion? Where?
We think it's coming from a couple different places, right? We think they're taking share in grocery. We've identified price gaps which continue to widen and we think go to Walmart's favor. We think over time margins can improve. You know, they've kind of committed to growing margins faster than revenue growth, and we see that momentum accelerating. And a third plank is we think there's momentum in Sam's Club. We think people haven't paid enough attention. You've seen this outperform Costco for the past couple quarters, and we think that this is a business that over time can be a real growth vehicle for the total Walmart business.
How much is your thesis tied to the economic cycle? There's always this discussion about how Walmart tends to potentially be a beneficiary in down economies because, of course, we all are looking for bargains then. How much does that factor in?
Look, I think some of that's starting to break down. So clearly Walmart does benefit from trade down. They are seeing a higher number of over $100,000 households buying there, but they've also seen weakness in some of the discretionary parts of their business, right? If it's baby, if it's home. And so we actually think that if the economy remains more stable and maybe doesn't enter a recession, then they can actually benefit as some of these discretionary categories begin to improve. I think what's happening is customers trying Walmart maybe to try to stretch that dollar, and they're finding that this is a great shopping experience.
And then I want to get your thoughts on shrink and how much of a problem that is for Walmart. Of course, we heard a lot about that from some of the big retail CEOs over the last earnings cycles, that you saw that shrink really start to eat into actually the company's bottom line. I know that Walmart has said that they're actively managing shoplifting. How are you factoring that in?
You know, it's something that we've had to account for really across our retail coverage. You know, Walmart has added a number of passive deterrents. They're changing the way that, you know, certain sections are staffed. And I think that they're taking a closer look to see if, you know, because of shrink, do certain stores become less profitable, and over time, do they have to exit those locations? So I think it's a multiple, you know, different types of solutions for it, but we think all of retail is going to have to try to fix this.
Yeah, it does definitely seem to be an industry-wide problem, one that will continue to follow. I also want to get your thoughts on Sam's Club, because you write in your notes that it's underappreciated, the turnaround that has been seen. Talk us through what you're seeing that maybe the rest of the street is missing.
I mean, you should step into Sam's. I think what's interesting is that Sam's has improved its merchandising, it's improved its focus on fresh, and I think they have a much more compelling merchandise assortment than they did a couple of years ago. The other piece of it that I'd add, though, is that Sam's has spent over a number of years time improving the tech experience. So you can go through a Sam's with your mobile device, check out on your way out, right, and not have to wait in those egregiously long lines at some of their peers. So I think it's a combination of really emphasis on innovative technology and really good old merchandising.
So when we talk about, I guess, what's next for this company, I mean, we're talking about a behemoth of a company, a relatively mature company. And, you know, look, I mean, there is certainly value that's already being generated here. But is there a bigger growth story? Is there something that they do that, I guess, takes them from just being what we know Walmart to be today to being something bigger or better?
No, I think we're seeing the shoots of this all over the business, right? We're seeing that more affluent customer come to Walmart. When that more affluent customer sticks, right, they're going to buy other types of things, higher margin items. I think we're seeing a really interesting advertising business that's taking hold, and that's taking hold because they've invested in their e-commerce. So I think, and you've got an international business that, by the way, over the past 4 years has really repositioned. They've jettisoned a lot of these legacy markets. They're really leaning out on high growth markets like India, like China. And so I think you have an international business that's been retooled in addition to Sam's. So I think you've got all of these pieces that are, I think, working for them, and that we think will make this a very compelling growth story.
Okay, so that's the story for Walmart. I am curious, Ed, that when you sort of lay out that, I guess, relatively bullish case for Walmart, does this come at the expense of some of its competitors, and not just the traditional ones, but even some of the newer entrants, if you will, into this retail space?
Yeah, no, clearly Walmart's taking share really broadly. I think we're going to see an accelerated period of retail bankruptcies, so in the traditional space. But I think even in the e-commerce space, there clearly is a market leader in e-com and Amazon. But I think that Walmart, through offering store pickup, great prices, and now the Walmart Plus membership, is providing to be a pretty close number two. And I think, again, the momentum that they have in linking stores and online is a key differentiator.
All right, Ed, we're always great to catch up with you. Ed Yerma there over at Piper Sandler, an upgrade on Walmart, a relatively bullish case for the stock, 30% potential upside here over the next 12 months. Of course, Walmart, one of the most recognizable brands out there. And in fact, when we talk about brand recognition, brand value, and brand equity, there's a big question out there that investors have. How exactly do you put a price on that? Our next guest has some thoughts on that. Aswaf Damodaran, NYU Stern School of Business, professor of finance. He's stopping by the program in just a second. Stick with us. This is Bloomberg.
IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on a size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen. Welcome back to Bloomberg Markets to Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joining us as he does every day at this time. And David, we were speaking a little bit earlier here about brands, right? Yeah. And the value of those brands, the equity of those brands, if you will, but more importantly, how an investor, and for that matter, regulators, puts an actual price tag on that.
Yeah, we spend so much time and money on brands, and we say that they're very valuable, but how valuable are they? And how quickly can they be effective? We saw it at the beginning of this week. It was so much news this week, Romaine, with the Fed and with the numbers about the economy. We forget that Elon Musk decided to change Twitter into X, as we know, whatever that is, the universal app. And there was reports at the time that, in fact, that was going to reduce the value of the company by somewhere between $4 and $20 billion because of the damage done to the brand. Now, I don't know about you, but that's a wide range, $4 to $20 billion.
It's a wide range, but it raises a big question, though, about the value of those brands and why you don't necessarily walk away from them. Now, he may have other motives for why he wants to sort of move to X instead of using the Twitter name. But again, what is that value and why turn your back on it?
Well, and it also points out something. If you have a plant, that can't disappear overnight. You can't just eliminate that with a stroke of a pen. If you have a brand such as Twitter and you say, let's call it X now, you can literally really change the value of that with the stroke of the pen. And that really raises questions for investors, Romaine, as you go about investing, or if you're doing a merger and acquisition, what valuation you put on it when in fact it's so intangible?
Well, I've been fascinated by this because I'm going to date myself a little bit, but like back in the 90s when I kind of, really sort of to kind of dive into this business and learn about accounting and things like that, there was a lot of talk then about how you value intangible assets, if you will. So whether it's the brand name of a company or other sort of intellectual property. And there was a great paper out that it was like Len Nakamura over at the Fed wrote basically kind of a roadmap for this. And the problem, and I think that one of the guests that we were trying to talk to today, is that there really are no clear accounting rules for how you do this. And this is a big part of the reason why you don't see this on company balance sheets.
Because the accounting rules were developed for the manufacturing age. When it was plants and it's
you need
equipment.
Something you can touch.
And you know exactly what the value of that, you can put a valuation on it. But increasingly, as you know so well, Romain, the entire economies have changed. As we've gone into the internet, we've gone into intangibles. And so a lot more of the valuation is in things that you can't put a value on. And what does that mean for investors?
Yeah, and I was looking at Interbrand, which tracks this stuff. I mean, they look at Apple, for example, just the name, that brand name alone. They're saying it's probably worth something like $500 billion alone. That's not, we're not talking about the market cap, we're not talking about the revenue, just the name. Same thing with, you talk about, you mentioned Twitter maybe being 4 to 20. I was looking, I think Facebook has something like a brand valuation alone of 40 to $50 billion. And you have companies like Coca-Cola, which of course are iconic, McDonald's, things like that, that to a certain extent, even if the business suffered, that brand would live on.
Well, I mean, you know so well, you know longer than I have, that ultimately that valuation is a question of discounting future cash flows.
Yes.
And so when you say, okay, if you had your iPhone, but it wasn't called an Apple, it was called something else, what would be the value? What would be the diminishment of the money you'd pay to the company for that? I don't know how you figure that out.
I don't, but it has to change, right? Because, I mean, the whole thing that Nakamura was talking about, Aswath Damodaran, and a lot of these finance experts have talked about is that this has become a much bigger part of our economy, a much bigger part of corporate America, and to just simply ignore it, you can't do that anymore.
It also raises questions from so when you look at balance sheets, when you look at things like price to book, what does price to book mean in that world? Does it even mean anything? Are we outmoded in some of the ratios that we use as we really assess these things?
I think we are, and I think you see this a lot when companies do get bought and sold, and that's where the buyers often have to come in and try to make more accurate valuations to make sure that they're getting a good fair
But that, as you know, that's part of the problem, because so much of a balance sheet these days is in the intangible goodwill. Goodwill is just created. You say, I'll pay you 100, but I can only account for 30, so 70 is goodwill. It's just the difference between what I'm paying for it and what I can actually prove its value. So we have no idea what that goodwill is actually worth.
Now, how do you amortize brand valuation, right? I mean, like you said, you mentioned a factory. You know, generally you can sort of create a model for the depreciation of a physical asset, or the appreciation for that matter. You take it both ways, but how do you do that for a brand?
I must say, I worked for the Walt Disney Company for years, and we used to talk about we used to talk about brand all the time. And the Walt Disney Company invests an enormous amount of money in brand. I was never in one conversation that asked the question, what's the return on that investment? How do we calculate that? We're putting all this money into it. How do we determine what money is well spent for brand and what isn't well spent for brand? How do we connect it up with increased revenues and therefore increased operating income?
And if you ask executives about that, I mean, at least as a journalist, you never really get a straight answer. I mean, we want to talk about income statements, cash flow statements, balance sheets. I mean, you look at some of the selling and general administrative expenses, you can get a better sense here of brand spend or advertising, whatever you want to call it here. And you can see there are certain companies like Coca-Cola where it just dominates their spending because it doesn't cost much to produce a can of Coke, but administrative expenses, you can get a better sense here of brand spend or advertising, whatever you want to call it here. And you can see there are certain companies like Coca-Cola where it just dominates their spending because it doesn't cost much to produce a can of Coke, but it costs a lot to market that can of Coke.
But to bring it back to X or Twitter, one of the things that I was wondering about was,
are you on X?
I actually am. I went right on it to figure out what it was and how it worked. But I wondered as it happened, how much of this is Elon Musk deciding actually Elon Musk is the brand, not Twitter? But he'd rather have his brand in there. And what is the Musk brand worth at this point? Probably a fair amount.
That's a good point. And I think with his ego, that you're probably onto something there. And maybe, and look, and in fairness to him, maybe he can take a simple letter like X and turn it into a proprietary brand that maybe is more valuable than Twitter down the road. But at least in the initial sort of transition here, has a lot of people scratching their heads.
But as you say, Romain, more valuable if you can get more money for the advertising on X, as we now call it, than he otherwise could. And that's the question: is it going to increase value, even as we see Twitter X is now cutting the price of advertising to try to get advertisers back in?
Yeah, and this is the challenge, though, for folks on Wall Street when you're trying to value a company, whether it's publicly traded or like X, whether it's private. Here, you have tons of people on Wall Street. This is their job to sit there, look at these spreadsheets, and try to figure out a way to put a value on that and try to figure out whether that value is going to go up or down.
Which raises a larger question as well. You're exactly right. There are a lot of people on Wall Street whose job is doing that, and they want to make sure they keep doing that job, so they keep generating that. The question is it really worth that much with all those spreadsheets? When you take all the spreadsheets and try to put your brand into it, is it really telling you anything at all?
It's hard to say. And like I said, Twitter X is easy to pick on that because that's kind of, it's easy to pick on Elon Musk these days. But then you go back to Meta's, Facebook's, I should say, transition to Meta. That was really derided at the time. But, at the time, but now you look back and it's just Meta, right? We've all sort of accepted it for what it is.
Well, and given some of the earnings we just saw, some people are suggesting they went to Meta too soon because the thing they're making money off of is actually a good old-fashioned Facebook and the related brands, not Meta. They're not making money off of that yet.
Yeah, there were never any discussions when you were at Disney for them to change their name to
Disney?
Yeah.
Oh my goodness.
Did you just pick a letter?
No, we never talked about that. Heaven forfend. Jeez, that would be heresy. You'd be kicked out right quick. Walt Disney is a big factor there still.
Well, David, I really appreciate you having me on as a guest on Wall Street Week Daily. Who do you got teed up for tomorrow?
Guest, We're going to have actually a guest tomorrow. We're going to talk to Ralph Schlosstein of Evercore about what's going on with M&A. We know it's really gone down. We think it's going to come back. What is that shaking up? And then also Darren Williams, you know him well, Romaine, of Southern Bancorp, about all the continued shakeout for small regional banks. That's at 6 p.m. Eastern Time tomorrow on Wall Street Week.
All right, be sure to catch up with David Weston, also here every day around this time on Bloomberg Markets to close. A big focus on the final hour of trading because the positive vibes that we had coming into this session here, that risk-on vibe has completely flipped to risk-off. All of the major indices right now in the red. The Dow down about 0.5%. Similar moves lower for the NASDAQ and the S&P 500. The Russell down almost 1% here on the day, and a lot of activity right now going on in the yield space. Your eyes do not deceive you. A 10-year yield and a 30-year yield back above 4%. We'll be back in a moment. This is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, everybody. Happy Friday's Eve. Yep, that's what we call it around here, or AKA Thursday, July 27th.
I mean, you're in a really good mood. Why is that?
I'm taking some time off.
Oh, finally.
6 months. Oh, wait, I can't do that.
I deserve that. I was waiting for that one.
No, I think, kudos. Every company should do what we do and more because, man, having a little one, it's a lot of work, and it's really good for them to have their parents around, especially in those early days.
Yeah, it's been a good first week back, and I'll be off tomorrow as well. And, we'll be back together in about a week.
And you're sporting new glasses, baby.
I got new glasses.
Yeah.
I did one thing over
I'm
the
going
last
to do a
2
Twitter
months.
poll. You can vote.
Okay.
Yay,
That
nay,
sounds good.
or...
Yay or nay?
When did Gene Levy walk in? No, I'm just kidding.
That's pretty good. They do look like his glasses. Maybe
No, they look really good. They look
you.
really good.
I can
All
see well. That's all that matters.
All right, what doesn't look so good, certainly if you're trying to be bullish in this market, is what's going on with stocks because they are definitely off their lows. It's, did you check out that 10-year topping 4% because of that upbeat economic news that we got today? I mean, growth coming in well, inflation easing, labor market strong, businesses are spending, consumers are spending. Well, yeah, you're going to have yields move up. And you know what? It also means, hey, Jay Powell, I get it. You left the door open because you know what? We ain't maybe done yet.
Yeah, we're going to talk about all that and more with Mike McKee in just a few minutes. He, of course, was at yesterday's Fed policy meeting, and he's going to bring us up to date with what all this eco data means, plus 2 C-suite executives joining us this afternoon, Carol.
I know, man. The duo of the CEO of Mattel, Ynon Kreiz, so much to talk about, including the Barbie movie, the outlook, the Hollywood strike, and then, wait a minute, his COO is leaving to go to the Gap, so we want to get into that. And Chipotle's COO on its latest report, inflationary pressures. Investors kind of not so happy about what they got from Chipotle last night.
All right, well, we'll see. Speaking of Chipotle, what we got last night. Well, tonight we get Intel, Roku, Mondelez, Ford, T-Mobile, and Live Nation. They're all reporting just after the bell. Any questions about Taylor Swift?
We shall see. We shall see. We're also going to get into a story on the sorry state of search and how it's an ominous sign for the era of AI. A little bit of some things to worry about. And what else?
Oh, we got the founder of Course from Scratch on launching an online course, and then it's mosquito season.
I know, darn. I was gonna say.
You almost let that slip.
What makes them so attracted to us and why we need to care? We're going to get into that in just a moment. In the meantime, we do have stocks pretty much at their lows of the session. As we said, those yields moving up all along the yield curve, that 10-year topping 4%. We're going to talk about the markets with Romaine and Katie. Countdown to the close, folks. It is starting right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld, joined right now by our colleagues Carol Masser and Tim Stenivek. Welcome to our audiences across all of our Bloomberg platforms, television, radio originals, and our partnership with YouTube. A down day for equities and interesting moves right now, Carol Masser, in the Treasury space, 14 basis points higher on a 10-year yield.
Check it out, folks. You've got a 4% on the 10-year, and that is really, I think, the big reason why we're seeing those stocks move lower on this Thursday.
Carol.
Oh.
There you go.
Cause and effect? Is that what we're doing right now?
Is she? What's going on with Carol today, Tim?
She's going on vacation tomorrow.
She's
very
present.
excited.
I am so present here. I am so
gone.
present. I'm here. All right, let's talk about it, right? We had a bunch of economic news come out. Upbeat, growth looking good, consumers are spending, Tim bought new glasses, businesses are spending.
But he still didn't buy a tie.
No tie yet.
Okay.
Can you help him with that?
He doesn't
don't know how to tie it, Roman.
He's a California guy. What can I say?
All I'm going to say is, Jay Powell, you got this one. You left the door open. Maybe, we don't do more rate hikes. Maybe we do. And the economic data we got today says, yep, maybe they do. And that's why you're seeing the trade play out
Okay,
today.
but a lot can happen with that door open for the next 2 months. I mean, yes, we have Jackson Hole in a month, but we have 2 months until that next Fed policy meeting. We got payrolls next week. We, of course, have more earnings coming today after the bell. We got Apple and we got Amazon next week. A lot can happen in the next couple of months.
So what are you saying, Tim? You think this is like negative?
I mean, it could be negative. Let's say we Well, it depends on your definition of negative, right? If we start to see, let's say we see jobs numbers come down, quite a bit next week for July.
They would have to fall off a cliff.
They would have to fall off a cliff.
I didn't realize Tim was such a pessimist. I mean, I thought the data today was pretty good.
It is.
And it seemed to dovetail, Katie, I think, with kind of a trajectory that we've seen with this economy where inflation is moderating, but growth is holding up.
It was the same story, just encapsulated in two data prints, that you have a robust labor market and you have an economy that's holding on here. It's doing pretty well, and you can see that in the bond sell-off, though I think that Bank of Japan news is fueling the bond sell-off right now. Let's talk about another big story that we got today. Of course, that was we finally got regulators unveiling those capital requirements on banks, tighter than probably the industry would like. Of course, banks with at least $100 billion in assets might have to boost the amount, or would have to boost the amount of capital set aside by 16%. The 8 largest banks face a 19% increase that's expected to basically wipe out that big buffer that they had built up. And what it means for share buybacks, maybe we're not going to see those.
And one interesting thing I thought was interesting was the one that specifically related to residential mortgages. Basically, right now, the risk weighting is something like 50%, but they're creating a broader range. So it'd be 40% on the low end to 90% on the high end for large banks, which, I mean, you don't need to be a rocket science to figure this out. That's going to curtail lending, at least if you're a bank that's at the higher end of that range here. And that's raising a lot of questions as to why.
Yeah, but, this is a new thing for some of those smaller players. And all I can think about is the statements about, the private lending market's going to be like, hooray. What does it mean potentially for us and the implications as these banks have higher requirements and kind of more regulation, if you will, laid over them?
I do want to go back to the economy. Where are you going, Carol Master, for vacation? Are you going to stimulate the economy in some way?
Yeah, I'd tell you, but I'd have to kill you. No, I'm just kidding.
On air?
I'm going down south to spend some time.
Carol actually walks by my desk every day and she whispers that into my ear.
Just kind of kicks
What do I
it.
do? What do I do? I wave, but you're always so serious and intent. Gonna go down to the beach, going south to spend some time with my family and go do a little bit of sailing probably too.
That's great.
Yeah.
All right, cool.
Doing my part for the economy. Tourism, everybody's experiencing things, right?
Yeah.
Yeah?
Yeah.
Pent up demand.
Do we like Tim's glasses?
Are you flying Southwest, Carol?
I'm not.
Okay.
I'm not.
Tim, I like the glasses. I think that goes well.
What do you
Thanks
think?
a lot.
Romaine has he's got glasses down well. What do you think, Romaine?
I like them.
The thing you might not know about Romaine is he has so many different pairs of glasses that always match perfectly with his outfits.
I actually didn't
Subtle,
know that.
yeah.
Wow.
It's pretty great.
How do you do that? Do you have a whole closet at home?
Have you been going through my wardrobe?
I have my methods.
Just rifling through the closet.
Do you have one of those things, where you turn to see jewelry and stuff and it's just all glasses?
I think we got to go.
Is it like a Carvana for glasses?
I actually hear them in my ears.
Carol is already out the door. You can see it. It's going to be an interesting couple hours there over in Orlando Radio.
Maybe that's why I'm a little crazy. All right,
we have
guys.
guests in television here, Carol, we have to get to.
All right, we'll be back in less than an hour's time across platform radio, TV, YouTube, and Bloomberg Originals. I will be here. I'm not going yet. We'll see you at 4 p.m. Wall Street time.
My name is Michael. I got a nickel shiny and new.
All right, he is the man of the hour. He's the man of the hour yesterday, too, because he was in the same room with Jay Powell down in Washington.
Sounded good. Saw him a lot yesterday. Didn't get to talk to him at all because he was so busy.
I want to see what he has to say about recession schmession, because Jay Powell saying, that Fed isn't looking for a recession yesterday. And based on the batch of data we got today, I mean,
Goldilocks is, I think, how you described it. It's looking pretty good.
But is it quite the fairy tale, especially as you see the move up in yields?
Look, and we're going to be asking a lot of C-suite executives this question over the next few weeks as well as they report earnings.
All right, so let's get to it. Bloomberg International Economics and Policy reporter Michael McKee joining us from our Washington, D.C. bureau. Mike, great to have you here with us. It seems pretty upbeat, all of these data points. You were breaking them down. They were coming fast and furious this morning. Walk us through what the particulars were and what it tells about us cumulatively.
Well, the most important thing was that Tim Stenovich came back. Now the whole
true.
country is happy. We have seen consumer confidence skyrocket recently with Tim back, and yes, on the glasses.
Thank you, Mike. I appreciate that.
Let's talk about the economic numbers. GDP comes in a lot stronger than anticipated, although the Atlanta Fed called it. The GDP now number was 2.4. 2.4%, that's much better than the 1.8 expected and the 2% that we had as a final number for the first quarter. Personal spending, consumers, a little bit disappointing, 1.6%. They had been at 4.2% in the final revision to the first quarter. So maybe we will see revision higher. But what really impressed was business spending. We saw it up 7.7% for non-residential fixed investment, including like 9% on structures. And structures, factories being built, basically. And that seems to be coming from the money from the CHIPS Act and the badly named Inflation Reduction Act. But the idea that the federal government's going to kickstart some investment spending seems to be coming true. So good news there. We did see durable goods orders rise fairly across the board, although the big numbers came from Boeing, sold a lot of airplanes, so you kind of look past that. But as I said, there were some reasonably good numbers. And then jobless claims. How can they keep going lower? They keep going lower, 221,000 on the week rather. That's down from 228. And the number of people who are getting benefits, who are getting continuing benefits, drops by more than 100,000. So some encouraging news on the labor market, encouraging news on the economy. The question is, and we'll find out tomorrow, is what's happening with inflation, with the PCE inflation numbers for June that we'll get tomorrow morning.
I got a little bit of pushback when I was called a pessimist, I think, just a few minutes ago when I said, there is a lot of time between now and the next Fed meeting and a lot can happen. Were there any sort of cracks in today's data that indicate things aren't quite as good as people think they are? Or was it just perfect across the board?
Well, I wouldn't necessarily use the word perfect. Figure skating judges can always mark you down a tenth or two, but the numbers are pretty good. There's nothing that really cries out. The trade figures were down a little bit. Maybe that reflects the reshoring that we're doing, a little bit less exporting, a little bit less importing. But inventories were not built up a whole lot. They contributed a little bit to the overall growth picture, but that suggests that there's room for more growth. If inventories are low, especially as we get into the fall, into the holiday season, retailers are going to want to stock up, that sort of thing. So we could see additional growth on top of what's been going on as long as the consumer hangs in.
Well, it's funny that you say that because this morning, right on surveillance, there was that you guys brought up that about the inventories, and it's not a case of a demand element, but maybe a supply element, right? Right, because we know demand is out there.
Yeah, it's been kind of an unusual situation, not that everything hasn't because of the pandemic, but during the pandemic, some things were sold out and other things piled up. And so retailers had a lot of clothes that people weren't buying, that sort of thing. So they worked down all those inventories. At the same time, inventories of things like automobiles fell off because they couldn't get the parts. And so that's all being rebuilt slowly now. Retailers cleared out what they had. Now they can go back to buying stuff, the new fashions that you have to have so you can throw out all your old clothes.
Everybody's been buying Barbie. I'm just going to tell you, I've walked into places that have Barbie stuff, and it's just sold out, Mike.
Everybody, all the women I see are wearing pink. Of course, I'm one to talk. I was wearing pink yesterday.
Got purple on today. Hey, can I just ask you, is Jay Powell prescient? I mean, I don't know how much of this stuff, he's got a lot of stuff that comes, but it does feel like the way he kind of covered his tracks yesterday feels like he was right.
Well, he is trying to maintain a cautious optimism. The idea is keep your options open because you don't really know what's going to happen. It's been such a weird recovery, sometimes up, sometimes down. Inflation's been going down, but there's reasons to think it could bounce a little bit. So keep your options open was his motto yesterday, and he kept repeating the same things over and over again. But the interesting thing he did say was that the Fed staff is no longer considering recession as a base case. So there is some internal optimism at the Fed that matches the, at least, public relations optimism that he's been putting forward.
Mike, you mentioned the Atlanta Fed's GDP Now, which I don't know if all of our listeners and viewers are familiar with, but it essentially does exactly what it's described as, right? It provides a snapshot of what it thinks GDP is right now. Can you talk a little bit more about that and how that tool is sort of different from the official figures, even though it comes from the Fed?
Well, what they do is add up all the economic data points as they happen during a quarter. And they project if this is the way things stay, this is what the number will be. It's a little bit like a presidential poll. It's a snapshot in time. Doesn't really mean anything until the day before the GDP release, in which case you're going to get the number anyway. But as more data comes in, they adjust it up and down. And it kind of gives you a picture of which way things are going. It's rare that it ends up spot on, as it did this month, but usually it's pretty close, and you can tell whether the economy is growing or falling back from the GDP numbers as a quarter goes along.
So, Mike, you know, you've seen lots of market cycles. I say this to you all the time. You know, it does feel like Jay Powell and company are engineering something pretty incredible. It's pretty remarkable.
Does it rhyme with soft landing?
I mean, so what do you make of it, and what's the thing that we just got to be careful about? And is Jay Powell right that he's got to maybe be higher, though, for longer? Because it'd be very easy for, I know Tim, well, I'm sorry, I don't want to, like, reveal anything. But, you know, people are out there spending, and they're buying homes, and they're doing things. You know, if rates go down again, like, could that just kick inflation higher again?
Well, it could. Rates are not going to go down, not for quite some time. Powell had a bit of a new formulation yesterday. Instead of saying higher for longer, he said high enough for long enough. So they are pretty close to being high enough. He said we're restrictive at this point. They may or may not want to go another 25 basis points, but the idea is to let the cumulative effect of all these tightenings start to really impact the economy, and you're starting to sort of see that. We did see consumer spending fall off a little bit, and we have seen the housing numbers slow down because of the higher mortgage rates. Nobody wants to sell their house. So there are some impacts. Do they add up to too much? That's what we'll have to watch and see. Has the Fed tightened too much? Could they go too far? Those are the questions that people are going to be concerned about from here on out as we watch the data come in.
Where should we look to see if the Fed went too far? Because, you know, just a few months ago with the regional banking crisis, the concern was, okay, the Fed did this. The Fed was responsible for breaking these banks. But we've moved on from that pretty significantly.
Yeah, the Fed's view is the bankers broke the banks, and they're relatively blameless, and they helped save the banks because they immediately came up with a new aid program. Their view is that it does look like we've gotten past all of the banking trouble, and we are going to see credit tightening, but that's to be expected because the Fed is tightening credit. So we should see bank loans come down, the level of bank loans come down. Credit card spending should fall off a little bit. Consumer spending should remain lower as long as it doesn't go below zero. And those are the kind of things to keep an eye on. If they fall off too quickly or too far, then you know we have a problem coming.
Hey, Mike, real quickly, 20 seconds, core PCE at 3.8%. That's a reminder that inflation's still out there.
That's a reminder inflation's still out there above the Fed's target, but there are some people thinking that we could come in lower than that tomorrow.
All right, we'll be watching. Michael McKee, thank you. Safe travels home. He is our international economics and policy correspondent at Bloomberg News from Washington, D.C., just on it constantly. Carol Masser, along with Tim Stanovic, right here in our Interactive Broker studio on Bloomberg Radio.